We're still looking at a labor market that is extremely strong.
This more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish.
It's all about the trend, and the Fed wants to see a downtrend that's convincing.
The market might be a little bit too fixated on this kind of will they, won't they question of a recession.
I think Powell muddied the water a bit this week, for sure.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Who remembers Payrolls Friday?
Yeah.
What happened to that?
See you.
Live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down about 1/3% on the S&P. There's only one stock to watch right now. Tom, it's SVB Financial Group. Their stock is down another 40% in pre-market trading.
It's jobs day for 8,553 people in Santa Clara, California. The good news, John, is we're going to do what surveillance does. Gerard Cassidy will join us. Michael Mayo will join us, and what they're going to tell you is this is idiosyncratic. This is not 2008.
The SVB CEO apparently told clients, stay calm, Tom, and then VC after VC came out telling their companies to pull their money. What do you make of that?
I call it a run on a bank, but Jimmy Stewart's not in the movie. What's important here, and this is Bloomberg Intelligence, Herman Chan and Sergio Ferrar overnight did fabulous work on this. This is basically two bond portfolios segregated, and they got to figure out what to do with them now that those said deposits are walking out the door. Most of the experts I talk to say they've been clumsy at it, to be kind.
Well, let's talk about why some of those deposits are walking out the door. So you mentioned Mike Mayo of Wells Fargo. He put out this in the last 24 hours. SIVB is the worst case. The core issue at SIVB is a lack of funding diversification. SIVB deposits are from VC, which has its issues. To us, the larger the bank, the more diversified the funding. And Lisa, I know you agree with that point from Mike Mayo.
That's been the big distinction of why, to Tom's point, this is not 2008. This is not going to be some sort of mass banking Armageddon. What this is going to be is increasing challenge in the smaller regional banks that don't have that diversification and are competing for deposits in a higher interest rate regime where suddenly that's going to erode profitability and potentially force them to sell to shore up with assets that otherwise are held to maturity.
John, I don't want to bury people down with a lot of math right now, a lot of CFA baloney, but this is from Bloomberg Intelligence. This is the Silicon Valley Bank. They have deposits that have grown 180% over pandemic time. Their securities, that portfolio Mr. Mayo's talking about, grew not 180%. They're supposed to match, sort of. 313%. First of all, I've never thought about it. I've never seen it. And as Mike Mayo and others are saying, this is basically a bond portfolio wrapped around a bank.
So let's be very, very clear. It's quite normal in banking. And Lisa, you're perfectly positioned to talk about this. This isn't a problem if you can hold those securities to maturity. This becomes a problem when you have to sell and those securities are underwater. And as we know, Lisa, given the bond action we've seen in the last 12 months or so, some of those high-quality assets, if you mark to market right now, there are some losses.
And part of the problem is that you don't see the losses because you don't have to identify the mark-to-market losses of the hold-to-maturity balance sheet in the quarters that lead up to an issue until you have to sell. Here's the problem. If you start having to sell some of these assets that haven't repriced, what happens to some of the less liquid debt? And this, I think, is the broader market question. What happens to debt that people thought, oh, maybe it's not going down because we're not seeing the pricing action?
First thing I did when I came in is I looked at the Bloomberg Total Return set of indices on corporate, on high yield, on full faith and credit. We haven't broken down there. To Lisa's point, John, if we see higher yields, if we see price down, does this idiosyncratic hat trick, let's call it that this morning, we haven't even mentioned BitDog, but the bottom line is, do these little events like Silicon Valley drift over into other major banks?
So let's be really clear here. That word you keep using, idiosyncratic, you're going to hear it a lot this morning. But I want to be clear about something as well. There is a challenge now to the broader banking universe. Mentioned it a few times already in our coverage in the last 24 hours. There will be a competition for deposits, and the banks will now have to respond to that. So Betsy Grasick of Morgan Stanley, she's published too, Tom. Fantastic bank analyst. She makes the same point. She doesn't think we've got a big liquidity problem in the banking system, but she acknowledges this. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS. Lisa, we're now at that point in the tightening cycle where it's high rates are great for banks until they're not. we're at that until they're not stage of things.
Exactly, because deposits are starting to leave and banks are starting to care. Remember when we were talking about there were so many deposits in the banking system that if they lost them, it would be a good thing, then they wouldn't have to deal with the other assets. Now it's really a problem.
Well, John, I know we got to move on here, but this is so important. Everything's fine and on the income statement. And that's the way banking is. Rates go up, banks do better until you come over to a balance sheet analysis. I know it's Jobs Day Friday. It's also Balance Sheet Friday. All of a sudden, with these banks, these idiosyncratic moves, we are looking at balance sheet analysis and not income statement analysis.
5 minutes in right now. Let's talk about that jobs number just briefly, 225, in case it doesn't get squeezed in the next 10 minutes or so. I'll whip through the price action for you just briefly. Futures are negative about 1/3 on the S&P. Yields are coming in about 4 basis points on a 10-year, 386. Just a massive move at the front end of the curve yesterday. 2-year yield lowered by 20 basis points.
Huge move, yeah.
Lisa, a 20 basis point move going into payrolls. And can we say this, Lisa, do you think it's fair to say that Chairman Powell probably doesn't want a hot print today, especially after the price action in the last 24 hours?
100%. He was trying to back away from saying a 50 basis point rate hike was a certainty. A hot print would make it almost an impossible aspect to avoid. He would have to be at least having a discussion about why he is not raising 50 basis points. 8:30 a.m., we do get that number. We also get average hourly earnings. The range of estimates on Wall Street for the just headline number goes from 300,000 down to about 200, 150,000 on the low end. Average hourly earnings might be more important. How much do we still see employees able to charge bigger and bigger pay increases? And then what's the read through in terms of, to your point, John, what this means for the expectation of how high, how fast the Fed has to raise rates? And I do wonder, in some ways, are we seeing something break in certain parts of the financial sector? Does that give the Fed a reprieve at all, or does it not? Because inflation is at the forefront of their consideration. Today, President Biden is meeting with European Commission head Ursula von der Leyen. They're discussing that trade clash over the $369 billion Inflation Reduction Act. And then staying in Washington, this is also going to be really interesting to watch at 9 a.m. Treasury Secretary Janet Yellen is going to be testifying in front of the House, talking about the debt, talking about Biden's budget. How does she really parse through what interest rates mean and what she thinks the consequences of expanding spending versus some of these tax increases potentially could be, John?
Hey, Lisa, great work as always. Let's get straight to Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, great to see you, sir. What a morning for it. Let's start here. What did you make of what was unfolding just yesterday through the session into the afternoon?
You know, I think, John, the word idiosyncratic is probably right, but here, that's not the issue. To me, the issue is we're at a situation, the Fed Senior Loan Officer Survey has never showed this kind of tightening in lending standards without being near a recession or in a recession. So is this SIVB situation going to create easing or even more tight lending standards? So the problem that the market has isn't necessarily just SIVB. It's where are you going to get the money? The bank lending standards are at a point that you've always been in a recession. You know, we could cover the yield curve ad nauseum, over 93% of possible yield curves between 3 months and 30 years. So pick your favorite yield curve, 93% of them are inverted. So there's and we're already at full employment. So the sources of increased money to buy things, do things, invest in things is really drying up, and this didn't help it.
Yeah, I really agree with that, Tony, the idea there that money is going to be the new plug given the new interest rate regime. Tony, it's simple. I was talking a year ago about the great zombie roll-up, and we're now there. And yet you and I know from our experience back to Robert McTeer and the savings and loan crisis that banks don't roll up. The government steps in and fixes these things before they roll up. Is what we're seeing in bank tension nothing more than part of the great zombie roll-up given new rates?
Well, it's an impact of the fastest rate hike cycle in history, faster than Paul Volcker. More significant on an early basis than Paul Volcker. And I'm kind of known, as you guys know, I'm kind of known as a permeable. I've always been that way when money is available. And it's the opposite when money is not available. So we have this idea somehow that we're going to have a soft landing in a place where you've got a generationally leveraged system, and we're finding out what that means. Not necessarily in where people look. It's never where people look, Tom. It's where people can't see. And where they can't see is the biggest growth area of finance in the last 15 years is private equity, private credit, and venture. So when we look at all of these factors, the idea that we're going to have a no landing or a soft landing in a generationally levered system with the fastest rate hike cycle in history doesn't make a lot of sense to me. No, it's not the banks are blowing up. The problem that we have is employment. We're going to get the number later. Employment goes down on an escalator and up on an elevator. And there's always a catalyst that makes it spike like that. And the catalyst is typically when you have a money shutdown and companies have to lay people off quickly.
A money shutdown, which we haven't seen yet. I am wondering, Tony, when you say you're the opposite of a perma bull, perhaps a perma bear, when money costs something in a tighter financial conditions, what does it mean to be defensive at a time when people over the past couple of months have been saying, go into the big banks? That is the defensive trade in equities.
Right. So to give you an idea of what the bank performance has been like, right before I came on air, I looked at it. So the 3-day rate of change on the KBW Bank Stock Index is down 11.96%, 12%. The only times I can find when I look back at that, going back, a few cycles is 1998, 2002, 2008, 2011, August of 2015, and 2020. So clearly, the banking system is telling us that there's some kind of issue here. And I would say, Lisa, that money has been shut down. Real liquidity is measured by M2 money supply. The first time in its history that I can find, in the data that I can find on Bloomberg, the first time it's had negative year-over-year movement. Now, granted, we had an incredible amount of liquidity coming out of the pandemic, but people spent that. That's the whole inflation and hyper-growth story we've already seen. When you've already spent it, you can't just say, oh, well, we're offsetting the pandemic liquidity because it's gone. You need new money.
Yeah.
And the answer is nothing that I can see here is creating new money. But we've been in this for over a year. I've been in this situation and feeling this way for over a year. That's not the time to go running for the hills. It's time to think about what you want to buy when you get that final leg lower, that third leg lower. Bad news becomes bad news.
Just 30 seconds here, Tony. Do you think that what we're seeing over with Silicon Valley Bank will change the dial at all for the Fed and how far they're willing to hike rates?
I think it's yes, because I think it gives them an idea of what can happen in things they can't see. The Fed does not have oversight on private equity, private credit, and venture. That's where the real liquidity squeeze has come on the rise in rates. And I think it's going to give them an idea of what this rise in rates means to small companies and emerging companies, which are really the heartbeat of employment.
Hey, Tony, this was wonderful. Just great to kick off this morning with you. Thank you, sir. Tony Dwyer there of Canaccord Genuity. This is the potential to be an absolute nightmare for the Federal Reserve. You get a hot payrolls print later this morning. You go again next week on CPI. And you face the prospect of needing to back away for financial stability issues before you've conquered inflation. Can you imagine having a conversation about going 50 basis points when there is a single bank in the United States facing a run on itself?
This is a nightmare, and it's something that I was thinking a lot about last night. What happens if we do get a hot print? What do we have if we've got stagflation, essentially, but even worse than that, where you have companies that are feeling the effects of higher rates, but it isn't working to curtail inflation? This Federal Reserve has to address inflation. When you take a look at rate hiking expectations, we're still baking in about 5.5% by the end of September.
Gerald Cassidy is going to join us later in the hour. We're going to catch up with him in about 17 minutes' time. Tommy just published, he said this: we believe yesterday's bank stock sell-off was overdone. A lot of the analyst community share that view this morning.
I did a very careful technical analysis of the big banks. I looked at 3 different series, including Standard & Poor's, DIV, and I looked at JP Morgan as the mothership. They did not break down. They pulled down to new levels. I get it, but I fully in support of what the gentleman from Tucker, Anthony, and R.L. Day says.
Nice. You got the full resume ready to go.
Yeah, well,
that's useful. That's good.
good.
I think this morning we have to draw a distinction between existential issues and profit headwinds. And we'll talk about profit headwinds for the broader sector with Gerald Cassidy as well. That's coming up. Futures negative 1/3%. Apparently it's still payrolls Friday.
For now.
This is just pure panic. So I think it's a one-off, intimately linked to the Silicon Valley and tech bubble. Today it's a reminder that you should keep your deposits only in heavily safe deposited and well-regulated large institutions. When people chase returns or services in small financial institutions, they always run a huge risk.
That was Davide Serra there, the founder and CEO of Algebris Investments, catching up with Francine a little bit earlier on this morning. If you are just tuning in, equity futures are still negative. No drama here, though. We're down about 0.4% on the S&P 500. The drama continues with Silicon Valley Bank. That stock is down in the pre-market by close to 42%. The broader banking universe yesterday, the KBW Banks Index, very much followed very closely here in the United States, down for 4 straight days. This week, we are heading for the biggest weekly loss since spring of 2020. That just gives you an idea about the magnitude of the move that we've seen so far this week. We will catch up with Gerard Cassidy in about 13 minutes' time. As I mentioned a little bit earlier, if you missed it, he did publish a little bit earlier this morning, Tom, about 10 minutes ago, and he just said this: yesterday's bank stocks sell-off overdone. The analyst community on Wall Street are making the same point that what's happening over here is very idiosyncratic, and what's happening in the broader banking sector is a profit headwind story that we can build on a little bit later.
We don't need a CFA clinic now, but what's really important here is to look at selected ratios, compare and contrast. I want to compare Silicon Valley Bank, I know you got a Christmas account there, John, with securities to deposits, the amount of bonds and stuff on the balance sheet as compared to deposits. It's a ginormous 70%, 70. At M&T Bank of Buffalo, which is widely regarded as the mother of all quality regional banks, it's 17%. So you compare 70% with 17%, and that shows how odd this bank is.
And not just that ratio, Tom. I think the bigger point that a lot of analysts would make this morning is the lack of diversification behind that deposit base. When you specialise in something quite volatile that's getting hammered by higher interest rates, whether that's the crypto universe or VC venture-backed
we haven't even
stuff.
mentioned that. But
that's the point that Mike Mayo and others are making this morning.
To me, they're separate, but as I said before, this is an idiosyncratic hat trick, and I'm in the camp with Cassidy Mayo, Davide Serra, and I believe our guest is coming up.
Are you going to get to our guest?
I'm going to get to our guest.
Cool.
I'm just looking at the news flow coming in on this, and folks, stay with us even through Jobs Day here in 2 hours. Philip Richards joins us now with Bloomberg Intelligence in Europe. Philip Richards, just as simple as I can, I know it's not related to European banking, but what's on the balance sheet of European banks?
Yeah, I think it's a very fair question, because I think some of the comments you've been making just now in terms of what are the risks and who's next. I think it's natural that if a bank gets into trouble, the market reaction is who's next, and you have to look at the assets they're holding. And certainly, if you look at the European banks, their direct exposure to the positions of Silicon Valley Bank are essentially zero. They're not in the venture capital markets in California. That said, though, the reason the banks are being sold off a bit, down 5 or 6%, is because you think, well, what other assets have they got? Where else can there be these unrealized losses? And for the banks, that's essentially the 1.6 trillion of sovereign bond holding.
I look, Philip, at something Jean-Claude Trichet told me years ago, which is the diffusement of finance across Europe. John Farrow's made it clear to me mortgage rates are different in Europe, inflation's different, utility bills are different. Do higher interest rates diffuse more quicker, more sooner, more rapid to European banks?
I think it depends which banks you're referring to in Europe, because they are a very diverse bunch across from UK to Italian banks. I think what matters for these banks, as I just flagged earlier, is about this sovereign debt holding. So the holding issue of bonds by the governments across Europe. But of course, when interest rates are rising very aggressively, like we've had over the last 6 to 12 months, then the price of those bonds goes down. So therefore, the banks, if they're holding those bonds, they will get unrealized losses on their balance sheets. And that's the risk for the banks people are looking at.
There's a profit story here as well, Philip. The headwinds that these banks might face now, net interest margins that might have to be reduced, the competition for deposits. Philip, how do you see that playing out now, given the news of the last 24 hours?
I think it's very true. I mean, we're in a sector now of European banks which are up about 45% over 6 months. So we've had this huge rally. And that's probably why there's been a bit of a, not so much panic, but quite a sharp reaction to the news, and almost unrelated news. They're down about 5% or so in Europe. But it's mostly a case of, okay, we've had all these big interest rate rises, huge increase in net interest income for the banks. Now, what will be the risks? What happens next?
Have we ever seen this before in terms of how quickly banks have had to increase the rates that they're paying depositors? And I say this at a time when it's difficult to understand the volume of new loans that can capture the higher rates that can add to the profitability that we were just talking about.
No, it's exactly the case. It's just about how quickly they can pass on those rises. What's happened so far, actually, the banks have not been passing on enough of those rate increases to savings, people's balances. And therefore, there's been a bit of a political uproar going on in Europe about why the banks are holding on to themselves. But of course, over the next few months or so, that'll be exactly what's happened. The banks are forced to pass on much of these rate rises to the banks. And if you are concerned now about liquidity as well, the banks will want to hold on to their their deposit bases. So again, it'll lead to increased rates even further. And that all hits, of course, their top line.
Hey, Philip, this was smart. Thanks for being with us. Philip Richards there of Bloomberg Intelligence on the latest. Thank you, sir. Again, drawing that distinction between the existential challenges that some of these banks face, like SVB Financial Group, and that's playing out quite clearly in the last 24 hours, particularly again this morning with the stock down in the pre-market by 42%. You could be right, Lisa, to say that it's idiosyncratic. It would be wrong to say there wasn't a broader challenge here, though, on the profit front. To your point a little bit earlier, people have been very bulled up, these banks, because of this hiking cycle, and now we're at a point where that starts to inflect in a different direction.
And right now, that's what really Gerard Cassidy's point, that raising rates are great for banks that have cheap capital. That is that real crux of the issue. And cheap capital comes from a really solid deposit base. Right now, we're looking at the potential for profits getting eroded at a time where I don't understand how many loans some of these banks can responsibly make to capture the higher yields. And that, to me, is the question. How much can you increase credit card loans? How much can you increase risky corporate credit, especially if that company is facing a recession and really high interest payments?
We've got to talk about the policy challenge confronting the Federal Reserve now as well. I mean, wow. Can you imagine if Chairman Powell had day one of testimony on Capitol Hill this morning off the back of a hot jobs report? I mean, this completely changes things, doesn't it?
Well, does it? And here's the question, right? If it does change things, if you end up with a Fed that doesn't raise rates as quickly, then do you end up with more persistent inflation, but a more solid financial system? The Fed has a lower bar to come into play.
Rock and a hard place.
Yes.
They're in a rock and a hard place now. I wonder if what we experienced in the UK, Tom, was a taste of things to come. Back in September, was it? September, October time, the challenges the Bank of England had to confront. If you face the risk of needing to comfort financial stability concerns at a time where you have to address high inflation, it's a little bit problematic, and we saw that how that played out in the UK briefly.
And it was predicted by a number of really smart people. What played out in the UK was a strategy that ran amok because of interest rate changes, and everybody knew the strategy would run amok if there were interest rate changes. John, some of us that are fossils harken back to the early 1980s, middle 1980s, where 32% of savings and loan associations failed in America. And yes, that was like Jimmy Stewart in the movies of long ago. I can't emphasize enough how these are idiosyncratic shops. But to Lisa's point, do they redound over to the other banking system? And the focal point is that the institution that's watching this is the Fed. This is not SEC. It's not, the alphabet soup that's out there. This is on Chairman Powell's shoulders, the part we never talk about.
There's also this issue of what does safety mean? What does defensive mean in a market that's been reshaped by higher rates? And people had come on the show and said it was the big banks. Does that change with a different profitability kind of equation?
Keep going back to the Treasury market move yesterday just to see the 2-year yield down 20 basis points.
I mean, you go to what's safe and then you expect the Fed to move as a response.
Part of the story, a small part of it was jobless claims coming in above 200K for the first time in 8 weeks. A small part of the story, I mean, we saw the move after claims, didn't we? It existed, it happened, right? We agree on that?
Okay,
then later in the afternoon, clearly there was a much bigger move coming into payrolls off the back of this story. Payrolls coming up in a couple of hours' time. Gerard Cassidy of RBC is coming up next. Live from New York City this morning. Good morning. What a week. Equity futures right now down 1/3 on the S&P 500. On the NASDAQ, we're basically unchanged on the NASDAQ this morning. Futures going absolutely nowhere there. I'll get to the move in SVB in just a moment. In the bond market, we have been all over the place. Let's take a look at the 2-year. 482.43, down 4 or 5 basis points this morning, down 20 yesterday. Earlier in the week, higher this cycle. The highest since we've seen it, going all the way back to 2007, 5.08%. That was 2 days ago. 2 days ago. It's 26 basis point move lower going into payrolls. That is unbelievable.
This is unheard of, John, and I have this up. I don't know if you've got the banner there, but it's really important. We had something really odd happen overnight in all this carnage. The 2's10 vanilla spread disinverted. It's less of an inversion. And at the same time, the longer range and shorter paper 3-month to 30-year continued to record inversion. I've never observed that. That's a delinkage here, and that was the flight to quality that you saw last night among 3-month paper.
Well, I'd go one step further than that, Tom. I think that Chairman Powell earlier this week lowered the bar for 50 basis points. This event yesterday raised the bar for 50 basis points. There is a belief that the Fed has to back away, which is why we saw a massive move at the front end of the curve yesterday.
I agree, and I thought of this coming in this morning. What do the dissents do? Do you all get on board with Chairman Powell to remain unified, or do you show the debate that's going on at the table?
Steve Englander sat there of Standard Chartered. Would he say they're lighting candles hoping that you don't get a repeat of the January data?
That's
I mean,
correct.
That is true this morning. They're sitting there hoping that doesn't have a 3 handle, a 4, maybe it has a 1, and we can sort of not talk about 50 basis points again, and let's see how this plays out. I want to see how this plays out. So here's Silicon Valley Bank. SIVB, SVP, take your pick. We're down about 44% in the pre-market, just adding to the losses from yesterday, Tom. Yesterday at the close, this bank was down hard, down 60% in yesterday's session.
And for Global Wall Street, it is idiosyncratic, or so they hope. Our team has worked overnight to bring you the best of Global Wall Street on banking, and we begin strong this morning with Gerard Cassidy, head of U.S. Bank Equity Strategy at RBC Capital Markets. He counted banks on Thursday in the savings and loan crisis of who would go out of business over the weekend. You know, Gerard, I mentioned the S&L crisis of the 1980s earlier. This is not this. What is this? If it's idiosyncratic, how do you describe it?
Tom, thank you for having me on. And you're so right. This is not what we saw in the S&L crisis at all. As you remember, Tom, back in those days, it was a credit crisis. This is not an issue with credit at all for Silicon Valley or for any of the banks. But you're bringing up a very good point. What has happened here is the deposits. Everybody is very concerned about deposit outflows. As you guys know, during the pandemic, because of quantitative easing, the Fed pumped in over $3 trillion of deposits into the banking system, and now they're starting to leave. These wholesale deposits, or surge deposits as they're often referred to, are the deposits that are likely to leave. But again, the system has too many deposits, if you can believe that. But the core issue here is we need to focus on core deposits. These are the small denominated deposits. I like to call them grandma and grandpa deposits. Those are very sticky, and those are very difficult to grow because it takes years to gather those deposits. The banks with high concentrations of those deposits, Bank of America is a good example, Fifth Third, Regions Bank, those deposits are sticky, and there's not going to be any real concerns about those deposits.
Gerard, is this a moment to acquire shares in quality banking? Can you use the opportunity of the last couple days in crypto and in Silicon Valley to go strong with small banks that you're noted for, or dare I say even the money center banks?
Tom, absolutely. And the reason being is that we understand how fearful it is and the uncertainty out there, no doubt about it. But when you come to core banking businesses, that the regional banks do, the community banks do, and the money centers. It's a very strong, stable business. There's no real systemic risk here. And when the stocks sell off like they did yesterday, it is a buying opportunity for the long-term investor. Also, the traders, of course, can get involved, the hedge funds and so forth. But we don't see this as a systemic crisis, nothing compared to 08, 09, or 1990, or the S&L crisis, Tom.
Gerard, just because it's not a systemic issue for some of these big names, and a lot of people listening will agree with you, does not necessarily mean it's a buying opportunity. And Gerard, you know where I'm going to go with this because you and I have already gone back and forth on it. There is clearly a profit headwind emerging for these big banks. I understand that they don't have the diversification issues, a very concentrated deposit base at a bank like SVP. I think we all understand the unique nature of what's developing in the last 24 hours. But Gerard, there is going to be a competition for deposits. And I think what we're all trying to understand are what are the profit headwinds that are emerging here? What are we seeing signs of? Particularly with, was it KeyCorp earlier this week, talking about deposit betas and the risk around that, Gerard? Can you frame that for us and what it means for the profits, the bottom line of these banks?
John, you put your thumb right on it. We held our 27th annual financial conference this week, in which Key, to your point, lowered the guidance on their net interest revenue growth because of higher deposit betas. So what's happening is consumers are moving into more higher rate deposits, which is squeezing the margins as we go forward. We expect net interest margin for the industry to probably peak in the first quarter or second quarter of this year. So there will be that pressure or headwind on the margin, but we have to remember banks can still expand their balance sheets through loan growth depending on how the economic outlook is. So net interest income growth, which last year was spectacular, we still see for most banks anywhere from 8 to 10% top line growth in net interest income, even with the margin coming down because of earning asset growth, and that will help them. We still think this year the banks as a group will be one of the few groups that put up EPS year-over-year growth as we see 23 today.
Gerard, I'd want to build on that. This idea of growing their loan books at a time where we potentially could be facing some serious headwinds. And also, a lot of companies aren't going to want to borrow at the rates that a lot of these banks are going to offer. I mean, how fruitful are they going to find the lending market? How risky are the assets they're going to have to lock themselves into in order to capture that higher rate?
It's a really good question. Now, in our forecast for 2023, we do expect loan growth to slow. History has shown the industry's loan growth will grow with nominal GDP. So if you expect inflation this year to average, let's call it 3 to 4%, we have 0% real GDP growth, or maybe slightly negative, you're looking at about 3 to 4% loan growth this year. So we would say 3 to 5% is not an unreasonable estimate at this time. And we've seen that in other slowdowns where loan growth continues. But you're right, the loans have to be underwritten very carefully because the real risk to bank profitability, even though I know this margin pressure is something to discuss, the real risk has always been credit quality. Credit quality today is quite good. So right now, if we don't have some sort of severe economic downturn, credit should hang in there this year. It will be higher costs for credit, but nothing like what we saw in past downturns.
We're talking about the biggest, best capitalized banks. And really the issue right now is in the smaller regional banks with more concentrated portfolios of depositors, of creditors. Bill Ackman, overnight of Pershing Square, came out and said that the failure of SVB could destroy an important longer-term driver of the economy because of the VC component of the economy, and recommends that if private capital can't provide a solution, a highly dilutive government-preferred bailout should be considered. Thoughts, Gerard?
I think that's premature. When you look at Silicon Valley, though it's important to the Silicon Valley area, obviously the country, and private equity, they're not the only players there, of course. And as you know, our biggest banks are involved in lending into the private equity business. So single-handedly, Silicon Valley, it's important to that part of the business, but it's not the only bank that has that have PE customers, private equity customers, or venture capital. So I think it's a little premature to be saying that at this time.
Joe, when Bramo says thoughts, Gerard, it means that she has thoughts, but she's really trying hard to bite her tongue and not say what she really thinks.
I was really
short, Gerard.
I was wondering what he wanted.
That was special.
That was special.
Gerard, can you give us a brief answer, please?
I'm going to butcher something Jeremy Irons said in Margin Call all those years ago. Speak to me like I'm a golden retriever. So, Jared, if you can, this is a bit of a blank spot for me. It's just regulation, and I'd love your thoughts on it because I know you follow this stuff really closely. Can you talk to me about the degree of regulatory scrutiny some of these smaller banks have received over the last decade compared to, say, some of the large banks, and the problems that might emerge for the smaller cap banks?
John, the regulators have done a very good job in changing the system compared to where we were pre-financial crisis, as you know, and you just touched on. The largest banks go through a stress test every year, and the banking system has been fortified very strongly since the financial crisis. Now, even the smaller banks, they too go through a very rigorous regulatory process. And so I would say that the regulatory picture and the capital levels are quite strong for these banks. And that's the critical part. When you look back to the pre-financial crisis days, the level of capital in the banking system back then was materially lower than it is today. Same thing with liquidity. All the banks have to measure their liquidity. There's a liquidity coverage ratio that it's called. where you have to measure the amount of deposit outflow over the next 30 days. And in that ratio, you've got to carry liquid assets to handle that. So the liquidity in capital is quite strong. Now, granted, we all know uncertainty creates fear. That's what we saw yesterday. As you guys said in the pre-market opening, we're seeing it again. But as cooler minds prevail, I think things will stabilize and people will realize that this is not a 08, 09, or even a 1990 moment.
If you're listening to this on radio, it means you can't see the view that Gerard Cassidy has out of his living room right now, which is just absolutely depressing. So don't tune in on TV.
He lives.
I mean, what is that?
He lives so large in Maine. The lobster shack down the road is $80 for a lobster roll.
We're doing it all wrong.
That's how large
doing
it is.
It all wrong. I say this all the time. I just feel like we're just doing it all wrong. Gerard Cassidy of RBC Capital Markets. Gerard, thank you, sir. On the banks, Tom.
On the banks, and it's who he is, and with Mike Mayo coming up, it's the same way. I'd say Mike Mayo has a reputation with a more larger regional bank and money center bank view. Gerard Cassidy helped invent the bringing to market of not tens, but hundreds and hundreds of small banks. And he has seen many banks, for whatever reason, fail. So when he tells me this is idiosyncratic, I'm leaning forward taking notes.
There is always, Tom, that cynical distrust of what emerges, though, in the analyst community on Wall Street. It would always exist. There are many people sitting at home right now and saying, yeah, right, you would say that. So we've all got some big questions to ask. We're going to ask the same questions to Mike Mayo of Wells Fargo a little bit later. This bank is down another 43% in the pre-market, Lisa.
And it raises some serious questions about who's next. I mean, not to say that there are others that are going to be big banks that collapse, but you got to wonder, is this really the only shoe to drop?
Futures right now, negative about 0.1% on the S&P 500. Got to talk about payrolls at some point. So we'll try and do that. Maybe until 8:32, depending on what it is. Futures are negative about 0.1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a big gain of 517,000 jobs in January, all eyes will be on today's employment report. Another round of hefty payroll numbers could cement the Federal Reserve's resolve to hold interest rates higher for longer. Economists predict 225,000 jobs were added last month, but there are signs the Fed's hikes are taking hold, with jobless claims rising to the highest since December. Donald Trump is likely to face criminal charges in New York. According to the New York Times, the former president was told he could appear before a grand jury next week if he wants to testify. That's said to be a sign that an indictment could follow soon. And the case has to do with the former president's role in paying hush money to a porn star. In Ukraine, President Volodymyr Zelensky is accusing Russia of deliberately targeting a nuclear power plant. The latest missile barrage knocked out its power for a sixth time. Zelensky called for sanctions to be placed on the Russian nuclear industry. The British economy showed its resilience in the face of strikes and rising prices. Gross domestic product was up a better than expected 0.3% in January. That followed a half-point drop in December. Figures raise hopes that the UK economy may avoid a protracted recession. The Bank of England will cut spending on climate change work and redirect the money to core functions. That's because of rising pressures on its costs. Bloomberg's learned the BOE will focus more on functions such as financial stability, markets, and a digital currency. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
A lot of conversations we currently have with clients evolve around maybe monetary policy is not as effective anymore in tightening financial conditions and possibly getting demand under control. If that narrative gains traction, you could easily overshoot peak rates that are currently priced.
It's amazing how the bias of a market shifts just like that in a day. That was Christian Muller-Glissman of Goldman Sachs about 24 hours ago, talking about the current stance of things, current conditions, and all of a sudden it starts to sound really dated and stale. And I imagine that might change again when we get payrolls at 8:30 Eastern Time, which is 1 hour and 43 minutes away.
The Bank of America analysts describe the stock trading range, and I realize this is applicable to the bond market as well, as neurotic. It is a neurotic trading range, and that is how I feel right now.
This whole year has been neurotic.
I know, I relate to it.
Totally. Equities look like this going into payrolls. Futures on the S&P 500, slightly softer, negative down lower by not even a tenth of 1%, down by 0.07%. Yields are coming in about 5 basis points on a 10-year, 384.90. If you'd like to hear the estimates, I'm here to provide you with the information you need. 225 is the median estimate in our survey. The previous number was 517,000. The unemployment expected to stay at 3.4%. That's the unemployment rate. And Tom, if you're looking at average hourly earnings, 0.3% is the month-on-month estimate. 4.7 is the year-over-year call. And all of this, of course, going into CPI next week.
I have no idea, but I had no idea 30 days ago. We got a commercial running on Bloomberg Television that shows the three of us dumbfounded, to be blunt, and we're going to be dumbfounded again. Let's get some wisdom on this. And yes, Michael Mayo coming up from her shop, Wells Fargo. We're thrilled. It's who Mike Mayo listens to on the economy. Sarah House joins us now, senior economist at Wells Fargo. No bank questions, Sarah, this morning. What I do is I get non-farm payrolls. I look at the revisions. I take a 3-month moving average. Are we going to get the guesstimate on revisions adjusted today? Are you going to see substantial revisions?
So I don't think we're actually going to see substantial revisions to the January number. So we actually had a pretty strong response rate, or at least it wasn't wildly different from the January averages. So I think there's less scope for that. And so I think what we're looking for instead is another pretty strong number. So 270,000, which is consistent with the jobs market still flying. But at the same time, we don't think hiring can defy the gravity of Fed tightening forever. So we do think a slowdown is in train, and we're likely to see it probably more likely here in the spring.
Your study of history, understanding that banking comes under a Fed purview as well, are the gyrations we're seeing in the land of Mike Mayo right now, do they redound over to your world?
Well, I think what they show is that the Fed tightening has consequences. So we've seen that the economy has tremendous momentum, and so I think that's why we've continued to see such strong inflation, the jobs market holding up incredibly well. But we don't expect to see the labor market remain immune from the tightening that we've seen to date. I think instead it's more that it's taking longer for those effects to be felt, just given that strength of momentum and given some of the many of the unique aspects around the current environment. So everything from the household balance sheets, corporate balance sheets, and so it's just taking longer for that to be felt, but it will be felt.
And Sarah, we were talking about how the move in the 2-year yield yesterday, and frankly continuing today, kind of highlights that the market believes that what we saw with respect to Silicon Valley Bank and some of the other disruptions could potentially allow the Fed to step away from the pace of rate hikes that they had been expecting 2 days ago. Do you think that that's correct?
Well, I think directionally it signals that the Fed does have to be more cautious as we get further into this tightening cycle. So we saw them argue for the 25 basis point hike last time was really supported. That step down was supported by the fact that we have seen quite a bit of tightening already. So 450 basis points through that move, and we hadn't fully felt those effects. And so I think what we're seeing in the markets over the past 24 hours supports that notion that we're getting to more of the fine-tuning stage, that we've done the catch-up, but now the Fed has to be a little bit more deliberate in where they go from here.
Do you think that all things being equal, we're likely to see a 25 basis point rate hike, that this basically green-lit just the slower pace, the slower grind as we wait and see what other casualties there are?
Well, I think the debate is certainly not settled on the March rate hike, whether it's 25 or 50. So obviously we've got this big employment report coming up today. We have the CPI report on Tuesday. And there's also a good bunch of activity data, so industrial production, retail sales as well, that we'll get before the next Fed meeting, that I think will indicate whether we have seen momentum really reaccelerate over the past few months and January maybe wasn't just a blip, or if January was more of a one-off.
Well, Sarah, the thing I'm going to do when this number comes out at 8:30 Eastern Time is maybe not look at this month's number. I'm going to that revision column. Might be the first thing I actually look at, Sarah. Are you expecting a big revision at all?
I don't think we'll see a significant one there. Again, the response rate wasn't terribly low for the January number, and I think even if you go back over the past years, you have to go back to 1994 to see a bigger downward revision for January than 50,000. So in terms of a negative downward revision, so wow. I think it'll certainly be important, but I'm not sure we'll get quite as big of a move as people might be expecting. Where ultimately I think the January hot print was driven by that mild winter weather, which that happened. It's not, again, a matter of that response rate.
Sarah House, thank you, of Wells Fargo, on the latest with the jobs report that comes out at 8:30 Eastern time, which seems to have taken second place to what's been developing in the bank sector over the last 24 hours. If you are just tuning in, SVB, Silicon Valley Bank, down by 45%. I think one thing we touched on in the last hour, but probably need to build out a little bit more, is the message coming from the C-suite at this bank is stay calm. You never want to have to say stay calm. But what's amazing about it, Tom, is what the clients are saying. Just VC fund after VC fund turning around and telling their clients to pull their money.
We have a banner up on TV right now I totally disagree with. SVB races to prevent bank run. I disagree with that completely.
Okay, you're going to have to say why. What's wrong with that?
This is the issue. This is a contrived venture capital, private equity bank. It's not a true bank. It's a private equity run. It's not a bank. It's never. Years ago, when I drove by it, I'd go out and lecture or talk at Stanford, and you drive by it in Silicon Valley. And everybody back then knew it's not doing mom and pop bank stuff. This is not Jimmy Stewart.
Oh, it's a different kind of bank. It's still a bank, Tom.
I don't think it's a bank. I think it's a private equity VC exercise, as frankly Mr. Ackman mentions this morning.
Okay.
I take immense issue conflating this with other banks.
I don't think anyone is.
I think a lot of people are this morning, and as you mentioned, the stock is down.
That banner certainly doesn't imply that they are. I think it's very unique to SVB. I think the CEO himself would say he's trying to prevent a bank run at this point, isn't he?
I think he's on the phone with how many VC people asking them, begging them not to pull out their institutional-sized deposits.
Sure.
Absolutely.
Well, by definition, then isn't he trying to prevent a bank run?
It's never been a normal bank.
I'm not saying it is, but it's still a bank.
Well, we could talk about a mismatch in maturities, and this was at the root of some of the issues in 2008. This is not 2008, but when we had all of the structured vehicles that had short-term paper that were backed by long-term instruments, it has a similarity. When you have a mismatch of maturities and you have to redeem on the short end, it could potentially cause revaluation on the longer-term assets. That's really one of the big questions underpinning this.
TK, do you want a final word?
I think Bloomberg Intelligence overnight, Chan and Ferro did phenomenal work on this, and they clearly show, as it's Balance Sheet Friday, that on their balance sheet is a very unique constructed loan operation to Silicon Valley. But it's not, as Gerard Cassidy said, it's not a bank. It's not a normal bank. It's not.
I think I don't want to get into semantics. You can't say both at the same time. It's not a bank and it's not a normal bank. It's either a bank or it's not a bank.
I don't think it's a bank.
I think we all understand that it has a very concentrated deposit and client base in a very specific industry. I think we all understand that.
I've never felt it's a bank 15 years ago, 18 years ago, whatever. It's a very unique institution working within private equity, venture capital within Silicon Valley.
Okay, well, it's down now by 44%.
And as you said, it is the deposits out the door.
Prime Minister of TD is going to join us on payrolls a little bit later this morning. Looking forward to that conversation around 8:30 Eastern Time. Looking ahead to payrolls, if you want the estimates and you are just tuning in for them, 225 is the median estimate. The previous number, of course, 517. The range, incredibly wide. At the high end, 325. At the low end, 80. I think you can fit a truck through that in a major way. Coming into this, just a major move in the bond market, down 5 or 6 basis points to down a 10-year. But the move we've seen on a 2-year note, just unbelievable. A 20 basis point move from New York City for our audience worldwide. This is Bloomberg.
We're still looking at a labor market that is extremely strong.
This more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish.
It's all about the trend, and the Fed wants to see a downtrend that's convincing.
The market might be a little bit too fixated on this kind of will they, won't they question of a recession.
I think Powell muddied the water a bit this week, for sure.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
90 minutes away from a payrolls report that is taking second place to action elsewhere through the last 24 hours. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance with equity futures just slightly negative by 0.1%. The attention of the world on one very small financial institution, a bank, SVB, is negative 45% in the pre-market. And Tom, that's where the attention is going into payrolls a little bit later this morning.
Day two of it, but for many people, I think Lisa underscored this earlier, this is a very different bank that has had substantial issues on their balance sheet for not 1 day, not 2 days, John, but this was seen coming by many, many people that were outside the discussion.
What a trip it's been in the bond market this week to have Chairman Powell tee up potentially adjusting the pace of tightening, introducing the risk of a 50 basis point hike. Some people even suggesting he lowered the bar for 50, and Lisa, the event of the last day or so, arguably raising the bar again.
I think that's what the market was suggesting with the move that we saw in the 2-year. Here's the issue. We've been talking about resilience. We've been talking about, are the rate hikes even having any impact on the economy? And it feels like things around the margins and the frothiest sections of the economy are starting to break. And a lot of people talking about what's next.
Does this Fed have to confront financial stability risk before it's conquered inflation? That conflict that's slowly emerging here, they're hoping we don't get a hot print this morning, right?
To the point that we've been talking about, though, no one's really wondering whether we're entering a new financial crisis. This isn't a 2008. So the risk of potentially seeing more casualties of this type of tightening and the Fed not willing to respond because they are fighting inflation is the worst case scenario for risk assets and what a lot of people are contemplating right now.
It certainly introduces a very different dynamic to financial markets. Futures right now down about 0.1%. Lisa's going to run through the day ahead in just a moment. Your bond market set up as follows. Your 10-year, 3.84%. Your 2-year earlier this week, Tom, 2 days ago, in fact, 5.08% on a 2-year. Right now, 4.82.
VIX popped yesterday, John. This is really important. The VIX has been quiescent. The MOVE index, the bond volatility's moved over the week. The VIX was 18, 19. Whammo. 23 yesterday in the carnage. Equities have joined bonds.
What a change. 87 minutes away in about 30 seconds, Lisa, in the payrolls report.
We're going to be looking at the headline number. The range, as you laid out earlier, is got about 150,000 in between the low and the high, with a high of 300,000. The expectation for a lack of revision downward for January, and that's going to be really important. I'm also watching average hourly earnings because the expectation is that they will rise on a year-over-year basis. How much does that keep up the pressure regardless of the headline number? And then, of course, the read-through into the bond market. How do the 2-year yields respond to the quagmire, the rock and the hard place, John, as you were saying, that the Fed is in, that their response to this labor market report will be definitively either a 50 basis point or 25 basis point move, especially in light of some of the turmoil that we're seeing on the skirts of the frothiest parts of the market. Today, President Biden is meeting with European Commission head Ursula von der Leyen. The point that they're going to be discussing is trade tensions, the Inflation Reduction Act in the U.S. Curious to hear how that develops. And then at 9 a.m., Treasury Secretary Janet Yellen will be testifying in front of the House, talking about the debt ceiling, talking about Biden's plan, his budget that he laid out yesterday. Fascinating to see this coming at a time of rising rates, higher inflation. How does she address that, John? I mean, she's got a really tough job selling something at a pretty tenuous moment.
We're looking ahead to the headlines that come out of that testimony a little bit later, Tom.
I'm so glad that we brought up Secretary Chair Yellen. That's what I call her now. I give her 2 titles. Because, John, in the nexus of this, if we get 50 beeps, if this happens, she's got to sit there with Powell and advise on our financial system. Those are 2 pretty good people to have with a little bit of experience.
Just a little bit. And, Tom, then potentially a conversation later on this year about the debt ceiling. That's the last thing they want to talk about right now, isn't it?
What are you doing this weekend? You're watching football, AC Milan won, I get it. What am I doing this weekend? I'm reading Congressional Budget Office. That's how serious this is.
You read CBO reports
I'm reading
over the weekend?
CBO reports over the weekend. Thank you.
Okay.
So does Priya Misra.
I doubt Priya's doing that this weekend. Priya Misra had a global race strategy at TD Securities. Priya, earlier this week, it felt like Chairman Powell had lowered the bar for 50. Did the bar just get raised again?
I don't think so. I think the The Fed is spooked by inflation. They are not willing to let the lags play out. I think, they're data dependent. And I think the labor market is strong and there is clear labor hoarding going on. So the labor market's going to be even more lagging than it historically has been. And Chair Powell did say there's going to be some pain. I think we're going through that pain. I think there's a lot more pain in store for us because we think this is going to be a strong report. Wages are going to be high. And I think the Fed has understood that to get inflation, core services ex shelter, down to 2%, you really need those wages to come down. We don't think, we're even close to that. So I think, if we get 200,000 today, the Fed's likely going 50. And they're going to potentially then open the door for another 50 because, they just, I would say they downshifted. Now they're back to the pace being a tool. Remember, they de-emphasized the pace and then now the pace has come back as a tool they're using to manage inflation. So it's tricky.
Yeah.
I think this data-dependent Fed is very hard to trade. You just have to be nimble. That's why the market moves 20 basis points.
Priya, in your call of 2022 on inversion, smartest person on the block, I've got to go inside baseball this morning and was stunned 2 hours ago to see that the 2-10 spread, which you followed, disinverted, but the broader 3-month, 30-year bond spread continued to invert. I believe I've never seen that. What does it signal to you when the vanilla spread disinverts and the broader spread inverts?
I think, in terms of monetary policy, I would say the 3-month 10-year is telling you that it's restrictive. Why that 2-10s disinverted is we're pricing in cuts in 24, which I think the market actually was a little too aggressive in taking those cuts out. I think the less of a hard landing, or if you have no landing in 23, you're probably having a much harder landing in 24. So I think the more we raise the terminal rate, the more cuts we should price in 24, maybe 25. And the market started to do that a little bit with this whole, financial sector concerns. But I think, if we get a strong number and the Fed follows through, they go 50, they raise the terminal rate. I mean, are we talking 6%, 6.5%? At that point, it's very hard for that 2-year to keep, rallying. So I would think that the curve stays inverted. I think some of this was the market extrapolating from SVB into the entire financial sector. I think there is going to be pain. I mean, we should talk about QT as well. Nobody's linking what's happening with the financials to QT. That is tightening policy as well. It's taking deposits out of the system. I think the Fed's telling us they're going to continue with QT. So I think there is more pain ahead, but the Fed is singularly focused on inflation. And so I think they're likely to overdo it here.
Priya, I just want to follow up on what you said. Are you basically modeling out a 6.5% Fed funds rate?
I think the market has to keep that as a decent chance. I think a 6% is quite possible if they go 50, and then even if they downshift to 25s, by July, you're at 6%. So it's not that hard to see. And, there are lags in the system. I would highlight a lot of people were expecting weak data in the first quarter. We turned neutral, depending on your view on inflation. We turned neutral either in September in terms of Fed policy or December. It's been 3 months since December. It's going to take some time. So our view is the recession is a fourth quarter, early next year phenomena. But the Fed is focused on inflation and they're fully data dependent. They're moving data point by data point. So, I think if the economy is going to slow down too late for the Fed to realize because they're basing it on very lagging indicators.
Well, Priya, how low is the bar then with today's jobs market, with today's jobs report, with respect to raising 50 basis points, especially in light of some of the casualties that we are starting to see emerge?
So I think, financial conditions matter. We also have a CPI report. I would look at wages today. So for today, if we get a 0.4 in 200, 250, I think they're very likely to go 50. But let's look at the CPI report. Let's look at financial conditions between now and the Fed meeting. If there's significant tightening in financial conditions, I think the Fed can then go 25, but raise the terminal. So, they've got different tools to play with. We do get the dot plot. But if financial conditions have only marginally tightened, we get another strong CPI and a strong payrolls. I think the bar is pretty low. Chair Powell suggests that, I think he's maybe regretting downshifting in Jan or that dovish press conference. I think he's trying to overcompensate. So there's a little bit of the Fed trying to figure it out, as we all are, as the data comes out. Unfortunately, the data, I think we're looking at very lagging indicators.
Priya, why are they so hesitant to use balance sheet a little bit more? to maybe fast forward, accelerate QT? He's asked about that, and he always talks about interest rates being the primary tool. Why are they so risk averse around that story?
Because these are very nonlinear impacts. There, actually, I completely agree with the Fed. I think we don't know how to model how much of the balance sheet is worth how much in basis points. It's highly nonlinear. I think the first, 1 trillion of the balance sheet doesn't matter. The second trillion becomes a lot harder. It starts to push real rates higher, like 5 to 10-year real rates move up, deposits flee. How do banks manage that deposit flight? There's capital implications. There's also funding implications. We're seeing that. I think, the SVB might be a special case, but the banking system for the first time really is dealing with negative deposit growth year over year. That's a function of QT.
Got to squeeze this in too before you go. You doubled down on that call on the 10-year. Seen massive moves in the 2-year this week. What have you made of what you've seen this week? Has that started to hit your conviction, or are you just doubling down again?
No, I like 10s. I mean, I would still stay away from the front end because the data is still strong. But the 10-year, I think you're setting up for a recession. You're also it's also a hedge against risk assets.
John, did I hear Ms. Misra model 6.50%? Is that a published idea from TD Securities? Did she clear that through McCormick?
And Priya, were you just floating the idea that maybe we go as far as 6?
It's just that the market pricing has to incorporate 6.5. I think the Fed just opened the door for much higher rates.
She does these trial balloons on Bloomberg Surveillance.
Is that what that was?
She's trying them out to see if compliance is listening in Toronto. She's just
I don't know if they were awake yet in Toronto. Priya, run. Priya Misra, TV. Priya, thank you. Doubling down on that 10-year call in the last couple of weeks. Your 10-year right now, 3.85. A feeling from Priya there, Tom, that perhaps the emergence of risk in the last 24 hours wouldn't dissuade the Federal Reserve of going big if we get a hot print later.
If she does 50-50 in a 6.5 view, all of a sudden the Bramo call looks brilliant. That's all there is to it.
I think the Bramo call looked brilliant yesterday. Coming up in about 30 minutes, this guy right here, rock star of the financial analyst community, Mike Mayo, senior equity analyst at Wells Fargo, is going to join us at about 7:45 Eastern Time.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Today's U.S. jobs report is likely to help determine what Fed policymakers do when they meet later this month. It's estimated that the economy added 225,000 jobs last month. Now, traders slightly pared back their bets on half-a-point interest rate hike after Thursday's initial jobless claims report. The number was the highest since December. Panic spread across the startup world due to worries about the financial health of Silicon Valley Bank. It's a major lender to fledgling companies. Peter Thiel's Founders Fund and other venture capitalists have advised portfolio businesses to withdraw their money. The shares of SVB plunged about 60% on Thursday. Its top executive is urging clients to stay calm. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders expected to agree to let European firms benefit from some of the battery subsidies that are offered only to U.S. producers. The leaders of France and the UK will seek a reconciliation in Paris today. Emmanuel Macron and Rishi Sunak will aim to turn the page on years of bitter relations between their countries. The issues include post-Brexit ties, immigration, and nuclear power. And Bitcoin is having its worst week since November. An equity sell-off, fear over higher interest rates, and a U.S. crackdown on crypto combined to hurt investor sentiment. Bitcoin fell below $20,000 today for the first time since January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Is this SIVB situation going to create easing or even more tight lending standards? So the problem that the market has isn't necessarily just SIVB. It's where are you going to get the money? The sources of increased money to buy things, do things, invest in things is really drying up.
Tony Dwyer, not a big fan of this market right now. The chief market strategist at Canaccord Genuity going into payrolls 1 hour, 13 minutes away with your market set up as follows. Equity futures just slightly softer. No real drama here. We're down by about 0.1%. Yields come in 6 basis points, 384. We've really backed away from 4% in the last couple of days, particularly yesterday on a 2-year yield, backing away from 481. Down 5 or 6 basis points this morning, adding to the 20 basis point move we saw yesterday. The estimate for 8:30 Eastern is 225. There was a feeling that we needed 225 and maybe a 0.4 print on CPI, and we were going 50 at the Federal Reserve. And I can tell you now, everyone is very, very confused about how high or low the bar might be for a 50 basis point move around payrolls. So if you get one of those middling numbers, it's going to be like, what do you do with that? What should we do with it?
Let's discuss this right now, because Priya Misra was great. If we get 50-50, as she didn't predict or forecast, but as she alluded to, that's 100 beeps in 6 weeks. That's a wow statistic for American banking.
What kind of data do we need to get that 50? Lisa and I have talked about this earlier in the week from Citi and Andrew Hollenhorst. They're looking for 255 today on payrolls. They're looking for 0.4% month-over-month CPI next week. They think that's sufficient still. Now, from an economics perspective, I think a lot of people might share that view. From a market perspective, given what we've seen, some of the de-risking in the last 24 hours, I think if the Fed decision was tomorrow, and it's not, of course, but if it was tomorrow, they'd have a very difficult decision to make.
And to me, it's off revisions. And Lisa, Sarah House made clear she does not see substantial revisions off that 500,000 statistic at Wells Fargo.
That's been one of the biggest issues for Fed Chair Jay Powell, because the revisions have been hot, right? So they basically had to revise up their expectations. I would argue that if they go 50, after what we've seen in the financial sector on the heels of a hot labor market, that would send a pretty daunting and cold message to this market, because what it is saying is the Fed put is dead, or the Fed put has been lifted to such a high degree that it's not going to come save you. Don't even look for it.
We've got one goal, get inflation down. It would send a pretty strong message. Tom, SVP, we followed it all morning, all yesterday. It's down another 41% this morning.
41% off 60%, so you do the math, and that's something like 36% left over after 48 hours. Joining us now, our chief bank correspondent. It's her fault. Shonali Bassick checks in this morning. I want a link of these 3 bank stories and which one is not the other one, Sesame Street and all that. You've got a unique bank out in San Francisco. You've got a unique bank. I get the S's mixed up. The one that's going on, the one that they're in workout on.
Silvergate.
Silvergate.
One liquidating.
So those 2 are really not banks, maybe, but Signature is. How many Signature banks of New York are out there?
There are a lot of them, but remember, Signature, the reason you're talking about it and worried about it at all is because they had some linkage here to the cryptocurrency industry. They had about 15% of their deposits tied to the crypto industry, but they have issued updated guidance here to kind of calm nerves of the market.
Yeah.
All deposits, as you guys have been talking about all morning, are not created equal. And so you're sitting here and they're telling you that those deposits tied to the crypto industry are going down. They are not sounding any alarm for caution, but we've been talking about this for 24 hours. If you're a smaller bank in America, you're worried for a lot of reasons. But again, I think the thing that's more concerning to me is people were not looking at the ripple effects. If the cryptocurrency industry is under pressure, why is it surprising that their bank is under pressure? If the technology community is under pressure, then wouldn't Silicon Valley Bank be a derivative effect of that? Remember, Silicon Valley Bank banks half of U.S. venture-backed startups, and not just that, their founders as well.
Know that. Interesting.
And so you're seeing here the ripple effects of the bubble popping. And I think what's a hard thing, and what investors have clearly not wrapped their head around, is what other derivative effects are there?
Is this an opportunity, and I go to the legacy of Mary Meeker and Morgan Stanley, or frankly the other major banks, is this an opportunity for them to go in crisis in Silicon Valley?
Listen, Silicon Valley Bank, the reason we watch it so closely is because it was such a darling. It was such a beloved bank. Goldman executives, time after time, have told me they wish they could own it. It was just too expensive for so long. The thing is, the question with Silicon Valley Bank is this an acquisition target after they've faced these kinds of deposit runs already? You have people like Founders Fund drawing caution at this point. You have individual founders, not just the companies, pulling money as well. And so those relationships, the bankers, remember, they've added so many bankers across many banks to build investment banking franchises for Silicon Valley Bank as well.
What's so great about you, Sonali, is you have so many conversations with executives of banks of all sizes. And I'm curious whether perhaps you're not hearing catastrophe, imminent demise kind of feelings, but you are hearing concerns about profitability, concerns about how to lend effectively, concerns about deposits leaving the bank. How much is that becoming the dominant conversation in the C-suite at some of the biggest banks right now?
It's a huge conversation. The deposit conversation has been an issue since, let's say, November, December of last year. When I sat at Goldman during their financial services conference, that worry about smaller banks really started to bake in. You're not as worried about that deposit impact for the bigger banks that are more diversified, that don't have to sell their maturities, sell their securities at a loss, as you've been seeing at these other banks. This is a balance sheet problem. The other thing, remember, I think another kind of cautionary tale here, a lot of this was set off by Silicon Valley Bank saying that they were going to raise money. I think when you're looking to the capital markets, if you're asking investors for anything at this point in time, you have to be really careful about what the use of those funds are and what the reason is, and whether it's signaling caution or whether it's signaling any potential sense of growth getting out of this period. Because if they smell blood at all, investors will run.
Do you hear about selling portfolios of less liquid assets? And I say that because that was also a piece of raising money, and that has a broader market effect as well. Is that something that's more on the table?
It is, and that's what happened with a lot of these banks. They've been having to sell securities at a loss, and that is a problem. And by the way, this is not just treasuries. These are mortgage-backed securities.
Of course.
This is where it all comes full circle again. And again, you're selling at the wrong time. So then you have a management question about balance sheet preparation. I would say one more thing, guys. Remember, there's so much negative sentiment in the market. I think back to a conversation I had with a senior executive at Goldman who kind of led the Big Short, and they reminded me that the money they made going into 2008 was not just shorting the mortgage market, it was shorting financials. And so if you take a look at the European financials, the CDS trading today, and you look at kind of the put options rising on a lot of these banks, this is such a big sentiment story. But will another bank or two face dire issues in this crisis? JP Morgan became JP Morgan from what it bought during 2008. And you have to wonder whether you're going to see moments like that again.
Can we just squeeze this in with SVB? Mm-hmm. You framed how important it is to that ecosystem. Why are they going out of their way to undermine it?
So that, if you look online, it's very interesting. There are a lot of venture capitalists defending Silicon Valley Bank as well. The behavior here of Silicon Valley to just leave somebody that was there for them when nobody else was. I mean, there's the same kind of frustration when it comes to Signature Bank as well. So to your point, there are a lot of venture capitalists out there saying, do these guys have nothing else to do than talk about potential bank runs? And should they not be causing such alarm over dinner last night?
Maybe they just want to cheapen the valuations so they can swoop in and buy it.
Or get the Fed to back away. I mean, the really cynical person might say.
No, that's been an absolute concern.
It's bizarre. Sonali, thank you. Really complex stuff. Very unique issue. Sonali Basak there on the latest. And all of this going into payrolls, which is about 35 minutes away. Ellen Zentner's going to join us shortly from Morgan Stanley. We'll talk about how high or how low that bar might be for a 50 basis point move from this Federal Reserve. But that testimony already feels just that little bit more stale, Tom, in the last couple of days.
I think we needed a third day.
Third day?
Third day would have done it.
What would the walk back look like on day 3?
I have no clue. Leave me alone. Give me a drink.
Are there any Fed speakers this morning or this afternoon?
It's the final day if they want to talk. It's the last day before the quiet period, going into the March 22nd Fed decision. CPI March 14th, so that's next week, and payrolls just around the corner. Ellen Zentner and Morgan Stanley coming up next. Futures, just a little negative. "60 minutes away from a much-anticipated payrolls report until like yesterday, and then things changed very quickly. Equity futures on the S&P down about 0.1% on the S&P right now, and the Nasdaq positive by 0.1% on the week so far, heading towards a week of losses, down about 3% on the S&P 500 so far this week. The banks have been absolutely hammered. The much-followed KBW Bank Index, 4-day losing streak, close here, worst week for the KBW Bank Index, going all the way back to spring 2020. It's been a wild ride, Tom, in both equities and the bond market too. You look at this 2-year yield, TK, where we've been this week, 5.08%. 2 days ago, 479 right now and down about 8 basis points this morning.
2-10 spread, 111 beeps, and we've come back in with disinversion to 96 basis points. I can't even do the math, John. I think it's 15, 16 basis points of inversion. So it's not only the level analysis, which people like Ellen Zentner have been great at, but it's the rate of change analysis going on.
210s right now, as you point out, Tom, negative 96, all the way back from 110 pushing 111. After the ADP report from a couple of days ago. And we've backed away because the 2-year yield has come all the way back in. A 20 basis point move yesterday, another 8 basis point move
nice chart there
this
on radio.
morning. Just an unreal move, TK.
Yeah,
Off the back of the risk aversion, there's just a belief that Chairman Powell lowered the bar for 50 and the market events yesterday raised the bar for 50.
And I'm going to also say, we can argue about bank runs and all that, but the reality is it's not that it's one bank. I believe we have 3 banks in the vista into the weekend, and maybe there's more we don't know about. You know, I mean,
there's
it's
a who's
some
next
of it.
feel to it, I get it. But if you just, cool minds will prevail, all of that good stuff.
Yeah, that
Steady
worked at
head,
Tottenham.
Whatever. Bramo's going to talk about SVB in a moment. I just wanted to give you Betsy Graysick's latest over at Morgan Stanley. Fantastic bank analyst, says this. We want to be very clear here. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS as well. So we're going to have this conversation all morning. We can talk about idiosyncratic, unique issues, existential threats, all of the above. That does not mean that what's happening elsewhere is not worthy of attention, because it is. There's a profit problem emerging here for some of these big lenders.
That's really the issue. It's the profit issue. And yesterday you saw that when the KBW index was not just SVB, but it was also JP Morgan, Bank of America. Today, they're clawing back losses in pre-market trading. They're basically trading flat. The major banks, SVB, not so much, down another 44% after yesterday's 60% drop. We're going to be watching this, not just to see how far the stock will fall, but also what it means for the depositors and what it means for being a possible acquisition target. Also, the lack of attention from regulators in terms of taking it over or ameliorating the situation in any way, shape, or form for them. Speaking of Silicon Valley and the potential casualties, let's talk about Allbirds, because that was the maker of Silicon Valley's favorite shoe. And they just came out with earnings, and those shares are lower by 21% after they had fourth quarter net revenue that missed estimates. And then they were also looking at negative projections. The stock of that company has fallen more than 80% since its IPO in 2021. Well, that was the darling of the
John,
Silicon Valley.
do you have those shoes? I don't have those.
No, but remember, everybody had them.
Yeah,
Ashton Kutcher was sort of like
Are
the
they
poster
expensive
child.
or they're just made in a very nice way?
They're very nondescript, so it's sort of like humble money, I think, is sort of the idea.
Stealth
which is
wealth.
Stealth wealth.
fits right
It's sort of
in,
this
yeah.
feeling.
Stealth wealth.
That's just what I'm saying. Also,
Stealth wealth to me is like Brunello Cucinelli, but it's Allbirds apparently on the West Coast.
well, that's, you're talking Europe, you're talking U.S. We can discuss all of that at another time. But I'm also looking at Oracle because they came out with earnings after the bell. You're looking at those shares lower by almost 4.5%. Basically, expectations were so high. This really speaks to the existential concern around whether we have overpriced cloud adoption and the revenues from that. And so you're seeing, even though they had pretty decent results, the fact that they didn't come in with the higher estimates are setting their shares lower.
Amid the banking discussion, amid this historic jobs day, we find calm with Ellen Zentner, the chief U.S. economist at Morgan Stanley. You published a couple days ago. I'm going to guess you'd publish differently this morning. What would you publish this morning on the linkage of the Fed, the triangle of the Fed, to the data we're going to see, jobs and inflation, and to the turmoil we see within the financial system?
Look, I think that I've been seeing investors in Europe, in South America, arrived back to New York yesterday. Throughout that trip, investors' views of what the data meant and what the Fed would do changed every day and almost meeting to meeting, where the bar for the Fed to go 50 basis points at the March meeting seemed pretty high. And then all of a sudden it's ultra, ultra low. I think that we're at a turning point. We're at a turning point, and we're talking about credit markets, right? We're talking about tighter credit conditions. We're talking about all these things that do show that rate increases are starting to flow through and impact liquidity in the economy and just spending, all of that, right? The Fed should wait for all of that. They should stay in this risk management mode. I think they want to stay in this risk management mode, that you can get rates as high as you need to get them, but you approach it more slowly. Will they get dragged into 50 because the market is pricing certainty of 50 basis points, and you don't have a lot of appetite to push back against that. And I think that's the question. I mean, my fingers are crossed that the data is, I mean, I can't call 190,000 payrolls weak. That's our forecast. But I pray that it's about in line with that and the market comes to its senses. The Fed does not want to do 25 here, the bulk of the Fed, right?
You think they want to pause?
Yeah. No, I don't think they want to pause. I think they want to stay in this risk management mode of a more safe approach to peak, wherever that peak is. And you go back to 50 basis points in March, on whatever this data looks like, the data may not look much different before the May meeting. And then what do? You do another 50.
This is a painful exercise, isn't it? And this is a really difficult one for you to answer, so forgive me, but I've got to ask it. How high or low is the bar for 50? What number gets it done today and next week on the 14th?
I think a 250. I think a higher than 250 for headline payrolls. And I think core CPI that in the components that matter, so the core services stripping out housing and medical, where, again, you get a third straight month then of no slowing there. I think that could do it. This is a tricky time for the Fed where there's not a lot of chance to communicate with markets if they want to push back. If the market sees the data and the market is going to price certainty for 50 basis points in March, I don't know that there's going to be a lot of appetite for the Fed to push back against that. That's a really tough job to do on a tight timeline. And you can see with the changes in financial conditions, the market's saying the world's not going to fall apart if you do that. But if you dig into pieces of of market pricing, the market is saying, hey, you better go 50. And, oh, my God, if you go 50, there's going to be a recession. We're seeing that pricing in parts of the market.
Well, but to that point, what is the potential casualty coming from Jay Powell's signaling of a 50 basis point rate hike? In other words, if they don't go 50, does that essentially lead to an easing of financial conditions, stocks rallying, spreads coming in on credit, all of these things that they look at as the transmission mechanism, or one of them, of their policy?
Yeah, so if the market is pricing 50 as a certainty and the Fed surprises to the downside on that, then you will get easing in financial conditions. And when we are in this inflation environment, and the Fed is still closely following inflation expectations, market-based measures, business and other surveys, you run the risk that the inflation markets say, hey, you're not doing enough again, right? And so they run that risk. And that's why I think that it's not that the market is leading the Fed to do 50 basis points. It's that they're all looking at the same data. The market has moved more quickly than the Fed. The Fed probably won't push back and says, yeah, we're sort of cuspy here on whether we can stay at 25s or not, and goes ahead and delivers 50.
Earlier this year, you were talking about a soft landing scenario or something that was a bit easier than the worst case scenarios of last year. Is that changing for you now?
I am still in the soft landing camp. I know it wasn't a very popular view last year, but how long can you have very strong payrolls and still think that you're going to go down the tube? So I am still in the soft landing camp. I'm still that the soft landing may not feel so good. We're at 0.4% GDP Q4 over Q4 for this year. Hey, that's a tenth higher than when we came into the year and thought we'd be at 0.3. But I will say that qualitatively or subjectively, the odds of recession do go up if the Fed is going to move back into a higher gear here and move at a faster pace.
John, we got to look at the markets here quickly with Ellen Zentner. They're moving. There's no other way to put it. Equity markets were south, and they've gone souther recently, and the yield space moves.
That's a 30 basis point move on a 2-year in the last couple of days.
Yeah.
And by the last couple of days, I actually mean 2 days.
Yeah.
We topped at 5.08%, and we're back down to 4.78.
It's going to break down right now.
On a 2-year. It's quite a move, Tom.
We got a headline out. Saudi Arabia confirms deal to restore ties with Iran. I don't know if I can link that into it, given all the turmoil. There we go. We just break down.
I wouldn't do that right now, but I think that headline is interesting on its own.
Yeah.
That Saudi and Iran agreeing to reports, Tom. According to reports, agreeing to reopen embassies within the next 2 months.
NASDAQ was green. It goes to the red here slightly. We'll follow that with Ellen Zentner of Morgan Stanley. I look, Ellen, at this jobs day, and Priya Misra was on from TD Securities, and she's looking at the sequence of being bold. Is this an Arthur Burns Fed, or are we still measured a la Greenspan?
No, I don't think it's look, I know why some on the FOMC might not like the idea of moving down into the 25s and just staying at a steady 25s, because then you run into the Greenspan criticism that it was sort of this measured pace and you didn't have the impact on financial conditions. Nor do I think, I think Chair Powell's made it clear he's not going to be named an Arthur Burns, right? He's going to be Volcker. He wants to err on the side of too much. You can err on the side of too much and do it at a pace of 25s, right? That is the safer approach to peak. And I very much believe that the bulk of the FOMC would like to stick with that. It's just that we are at a turning point where the data is still looking mixed and strong, but other variables, other elements of the economy and financial markets we're following are showing signs of cracks. So don't stop, but just you don't need to speed to peak quickly here. And unfortunately, they sent this message to markets. They got markets to accept that it was going to be 25s from now on. Yeah. And now that's called into question. So it's rate volatility. At the end of the day, that's what we're going to be saddled with, because in every single meeting now it's going to be, do they go 50? Do they go 25? Do they not go? But for right now, we're watching the totality of the data, as Powell is. Everyone's got a different definition of what does totality of the data mean. I would say even on a headline payroll, let's say it's a 250 payroll headline, but you've got participation that's picked up, and because employers are finding it easier to hire, wages come off faster. That is the totality of the data. It makes it harder to discern exactly what the Fed would do on that.
You're diplomatic. It wasn't just the downshift. I mean, they could have stuck with 25s. He just sounded less and less like Volcker from Brookings onwards.
Yeah.
That didn't sound like Volcker. I said earlier this week as well, the speech at Jackson Hole stood the test of time. And they could have downshifted and gone down to 25 and kept saying those words. But there was a language shift as well in the last couple of months that didn't stack up.
Balance of risk seemed more balanced until it didn't. And then all of a sudden we're flipping and flopping and super neurotic.
Ellen, I say this every month, but you're awesome. Ellen Zentner and Morgan Stanley. Ellen, thank you. Just amazing to hear Ellen say, I hope we get 190.
I know.
Like
I pray.
250
that would make
plus.
me super neurotic.
Yeah. 250 is a problem. Mike Mayo of Wells Fargo is coming up shortly. You don't want to miss this conversation. Just a rock star of the analyst community on financials. That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a big gain of 517,000 jobs in January, all eyes will be on today's employment report. Another round of hefty payroll numbers could cement the Federal Reserve's resolve to hold interest rates higher for longer. Economists predict 225,000 jobs were added last month. But there are signs the Fed hikes are taking hold, with jobless claims rising to the highest since December. Donald Trump is likely to face criminal charges in New York. According to the New York Times, the former president was told he could appear before a grand jury next week if he wants to testify. That's said to be a sign that an indictment could soon follow. The case has to do with the former president's role in paying hush money to a porn star. In Ukraine, President Volodymyr Zelensky is accusing Russia of deliberately targeting a nuclear power plant. The latest missile barrage knocked out its power for a sixth time, as Zelensky called for sanctions to be placed on the Russian nuclear industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The largest banks go through a stress test every year, and the banking system has been fortified very strongly since the financial crisis. Now, even the smaller banks, they too go through a very rigorous regulatory process. Now, granted, we all know uncertainty creates fear. That's what we saw yesterday. As cooler minds prevail, I think things will stabilize and people will realize that this is not a 08, 09, or even a 1990 moment.
Gerard Cassidy there of RBC Capital Markets. Let's get straight to the chart. The number you want to see this morning, SVB is down 48% in the pre-market. This is Silicon Valley Bank. It is down 48, pushing 49% lower in the pre-market, 54.30, and this is off the back of a move we saw yesterday, a move of some 60%. Mike Mayo is going to join us shortly, Tom, from Wells Fargo. The standout quote for me from his note right at the very top, he said, SIVB is the worst case. The core issue at SIVB is a lack of funding diversification. made that point repeatedly through this morning. Most SIVB deposits are from VC, which has its issues. To us, the larger the bank, the more diversified the funding. That's Mike Mayo of Wells Fargo in the last 24 hours, Tom.
Let's not waste any time here. Joining us right now is Mr. Mayo, senior equity analyst at Wells Fargo, iconic on the street back to days long ago with Credit Suisse. Mike, I've got 8 ways to go here, but I want to just simply say, is this morning the opportunity for the major banks to get competitive ground? Do the major banks benefit by all this turmoil because financial America will find comfort with big banks?
Well, the unintended consequences of everything that's taken place since the global financial crisis is it's increased the moat around the largest banks. So the regulation, the reduction of mergers, the too big to fail, all of that simply has reinforced the resiliency of the largest banks and resiliency of the balance sheets. Credit risk is much less. The resiliency of the business models, the scalability that you've gotten from technology, and yes, the resiliency of the funding. Even though deposits are declining some, we think the deposits are quite sticky at the largest banks, and they have all sorts of ways to fund themselves. So, the issues out there, that you see it in the stock price declines for the largest banks, are way overdone. The Fed stress test is conducted each year, and this year I see it as the combination of the last 3 recessions combined. And until banks can pass that test, they're not allowed to return capital. The issue of the moment is banks do have some unrealized securities losses. That's already reflected in their financials. And even if you assume they never sell these securities, deposits are still about 20% higher relative to loans than they've been historically. So since the global financial crisis, capital is up 50 to 100%. Liquidity is up about 50%. The credit profiles are vastly improved. Subprime loans are 80% less than where they were before. And Tom, as you know, I was fortunate to be the first analyst to testify on the causes of the global financial crisis to the Congressional Committee. And, as you know, I got fired part of that time when I was negative.
That worked out.
Well, it worked out in the end, not in the moment. But this is almost like the opposite of the global financial crisis, when there were not fears, and then things were about to crumble. And now the fears are really, way out there, when the banks are more resilient than they've been, in a generation.
So, Mike, we can talk about the resiliency. I think we also need to discuss the profit headwinds as well, net interest margins, how much they'll have to pay for that deposit base at the largest lenders. In just a moment, Mike, before we get there, I want to pick up on something you said. You said the moats around the biggest banks are huge. What about the smallest banks, Mike? How vulnerable are they? Have we seen, and can you comment on the lack of regulatory scrutiny that they've received over the last 10 years?
Well, the entire industry has had additional regulation and oversight. And so those industry statistics that I quote include both the small and the large banks. Now, you can always have idiosyncratic events, and that's going to happen. And I think one warning here is the risk outside the banking industry. So you have issues with crypto, and that can have a ricochet effect. You have an issue with VC firms not fundraising as much, needing to draw down their funds. That can have a ricochet effect. But really, I think what's not been seen yet, and I think you could see more, are bigger problems outside the banking industry, as so much risk has been pushed outside of banks into non-banks.
Which banks, which of the biggest banks are most exposed to a devaluation in some of the assets most exposed to those areas? And I'm thinking of private credit. I'm thinking of less liquid loans. I'm thinking of some of these industries that are seeing some serious distress.
Well, the truth is, and this goes back to the Fed stress test, every year the Fed is recalibrating the most risky areas. So the penalty for Goldman Sachs having private equity investments has gone up and up and up the last few years. So you have big capital behind a lot of those types of investments. So the entire industry has become much more resilient. So you have 4 categories of loans. One is consumer secured, those residential mortgages. You had that crisis in in 07, 08, and that's not happening now. Loan to values are great. You have unsecured consumer and credit cards are an area to watch. You're seeing issues on the low end, auto loans, low end consumer. And then you have on the wholesale side, secured, that would be commercial real estate. That is an area to watch, especially offices. So we're watching that. And then you have the unsecured wholesale or commercial loans, and you have leverage loans, and that's also an area to watch. Having said all that, this is really more of an earnings issue, not a liquidity issue, not a solvency issue. We've taken our estimates down on some of the banks due to higher funding costs. And if anything, so far, credit quality has performed stronger for longer than I or many have expected. And that's still likely to be good in a good economy.
We started out by talking about how, in some ways, episodes like this consolidate control, consolidate market share among the biggest banks. Which among the big banks will emerge as the winner from all of this, especially because that really determined the winners and the losers of the last crisis?
Well, you have seen a theme of Goliath is winning when it comes to capital markets, and it's really amazing. The impact of regulation. I mean, the likes of Goldman Sachs and JP Morgan consolidating wholesale market share. And on the retail side, you've seen the likes of Bank of America really lead the way with retail banking, gathering share. JP Morgan has also gathered share. So when these rules come out saying, okay, banks don't merge anymore, I mean, it's like the Jamie Dimon Protection Act. It just increases the moats around that business. And I think that's one of the unintended consequences of regulation and probably should be reconsidered.
Mike, I've got to squeeze this in just quickly. It's just on the challenges that Keene mentioned earlier this week. Is that not a profit headwind for some of the big names you just went through?
Oh, sure. Look, funding is going up. And last time I was on the show, I know Lisa asked me, when are we getting paid more for our deposits? Well, you're getting paid more for your deposits now. And so, look, the additional funding cost for the banks, look, this could wind up taking 5 to 10% out of our earnings estimates. On the other hand, the recession discount is about a 30% factor. So if you give up 10% of earnings but get that 30% valuation back, then that I come back a year from now and you say, wow, the banks actually performed well after all.
Mike, appreciate the hard work as always, and thanks for getting up early for us this morning. Mike Mayer there of Wells Fargo. If you consider 7:55 Eastern Time early, which of course we don't, I can't help myself, Lisa. I can't help myself. I think it's important, Tom, we draw a distinction as we have done all through this morning. And this is just an observation, not a judgment about where this is going. But it's interesting to see the market draw a very clear distinction between the big banks and what's happening with SVB this morning. SVB's down more than 50% now in the pre-market. Let's pick a bank, any bank. Bank of America in the pre-market is down just 0.2%. Of 1%.
I looked at it very carefully, but you nailed it with Key Corp. Full disclosure, got a family relationship there. Cleveland, Ohio, 17,000, make it 18,000 employees. And I looked at it, and the downdraft in the super regionals or the regionals compared to 2008 is a cup of coffee. We need to put in perspective, this is not 2008.
Futures right now just about unchanged as we count you down to payrolls. 34 minutes away. The payrolls report just around the corner.
Oh, yeah.
We still don't think we're through this period of volatility.
The market has repriced the peak rate for the Fed, for the ECB, and it looks much more symmetric.
We expect to see job growth slow. We expect to see some moderation from interest rate hikes.
I think it's very hard to look at the data and say with confidence we know where we're going. It's noisy.
The economy has changed structurally. There's so many things that are different than they were in 2020.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. On the oddest of days, it is a jobs day. We'll bring that to you in 30 minutes. It is, well, some form of run, dash, or whatever on the American financial system. We've looked at that this morning with Gerard Cassidy, Michael Mayo, Shanali Bassick, and others, but the best we can do is in this moment give you the markets. And John, you've talked up the 2-year yield right now down to new lows and almost breaking through where we were at midnight.
High of this hiking cycle, the highest since 2007, 5.08%. That was 2 days ago. Right now we're down to 475, call it 476 on a 2-year, down another 11 basis points after a 20 basis point move yesterday. What you heard from Alan Zentner and Morgan Stanley 15, 20 minutes ago on this program is remarkable. She's looking for 190,000 on payrolls in 29 minutes and hoping it's not larger. Hoping that jobs report is not bigger, because she is worried this Fed gets dragged back into doing 50 basis points, Tom, and causing too much damage.
What we're going to do on radio and television is slow it down right now. Nadia Lovell's going to join us. We're going to get to her in a moment, but we need to gather perspective here over what we've learned over the last 5, 6, 7 hours. And to me, John, the absolute unique thing here is the linkage of Chairman Powell into this financial challenge that we face right now.
And the prospect of real policy conflict.
Yeah.
If they get dragged into backing away, never mind getting drawn in to do 50. Let's say the data screams 50. Strong jobs report, who knows?
Right.
May or may not get it. Hot print next week on CPI, who knows? May or may not get it. But let's say it screams 50. At the same time, you have some of these banking issues. I don't care how big the lender is. If it's a small institution on the West Coast, whatever, there's no way that committee wants to sit around a table and talk about hiking interest rates 50 basis points with this kind of thing developing, Lisa.
Absolutely. And I think this, to me, is one of the big tests for a Federal Reserve that hasn't been that sensitive to the market response. They've seemed to shrug off trying to manipulate markets or direct markets, and they're saying, we're just going to look at the data. And they haven't necessarily responded as forcefully as people have in the past. So in this case, are they also going to shrug off some of the alarm signs that that we were hearing about from Ellen Zentner and just say, well, the data is hot, we're going to go 50?
Just some observation here for the two of you to dive into. Priya Misra in conversation frames out 50-50, looking for the first time, John, at 6.50%. She's on air, and George Saravelos at Deutsche Bank is talking up disinflation is here and looking at the 2-year law to take the 2-year to a lower yield, higher price. I mean, that's not the comedy, but the jumble that we're living right now.
What is sufficiently restrictive for the economy and what is sufficiently restrictive for the market? And they can be two different things sometimes. You mentioned the possibility of 6. Rick Reeder at BlackRock's going to join us in about an hour on Bloomberg TV and talk about the possibility
after the report
of getting to 6. Tom, we were at 0 12 months ago. I think often we forget that. It's important to frame that. We were at 0 12 months ago and the Fed was still winding down QE. QE and 0, and all of a sudden we're talking up 6 12 months later.
What did spreads do yesterday? I haven't even looked. I've been so busy.
That's exactly where I wanted to go. We did see some spread widening. We saw about the biggest 2-day spread widening in risky credit going back a couple of months, right? This isn't anything to write home.
The VIX went out as well.
But it's not, crisis. Here's my question. We've seen really anemic trading volumes in some of the riskier credit. We have not seen true price discovery at all for private and non-traded items. At what point do we start to see price discovery, and does that change the narrative in a new way? When you start to see forced sales, that's when, whoever said it, Warren Buffett is the person who is usually credited with it. When the tide rolls out, you see who's naked.
We're going to start the data check here to get to Nadia Lovell. John, I'm going to go to the Bloomberg Financial Conditions Index, which was shockingly accommodative. You mentioned yesterday or the day before how odd that was. It's over. We've moved from a positive standard deviation to a negative 0.01. I'm going to use the word massively restrictive on a 2-day basis.
And that steepening, or as you call it, Tom, disinversion, driven by the front end of the curve. Just this massive bid came back into the 2-year yesterday, continues this morning. On a 10-year maturity, we're down about 7 basis points. On a 2-year, we're down big time again. We're down 8 basis points on top of the 20 basis point move from yesterday. Remarkable stuff, Tom, just remarkable. Lisa mentioned that quote from Warren Buffett. I love those kind of quotes. Those lines. Margin Call with Jeremy Irons. Love that movie. Damien Sasso was listening a little bit earlier, and he said there's this line that comes from the character that Jeremy Irons plays. If you're first out the door, that's not called panicking.
That's
Isn't that a great line?
Well, that's,
if you're first out the door, that's not called panicking.
You hear the golden retriever thing.
That's right. That's it.
Do you know what I love? I've seen YouTube stuff. I've never seen the movie.
She's at the end of the table. That's a fantastic movie.
I've seen the YouTube things. Jeremy Irons, with his hands, he absolutely nailed what we do. His hands in those board meetings is exactly what it's
It was
like.
just an
Never seen
awesome
it.
performance, Tom. Awesome.
There you are, your movie review of this morning. Movies with John. Right now, saving the day, Nadia Lovell joins us, senior U.S. equity strategist. Nadia, you and your team have to write, given what we've just discussed. How does your research note change as you publish for Monday?
We're not changing much because I would tell you, Tom, we've been seeing some time that this market has been trading as if high interest rates wouldn't really matter. And while it might take some time for you to see the broader impact, there will be impact. And we're starting to see that. We saw it last year in the housing market with higher mortgage rates, in fact, in affordability. We're now seeing implications for the financials market as well and what it could mean. I mean, we've been looking at very closely at the senior loan officer survey. We've seen the recent one, additional tightening in credit lending standard, and we think that that's going to tighten further. We know that credit is a lifeblood of this economy. So we really think that the snowball, the headwinds have been building. And while the fact that we saw the warmer weather might have kept some of this at bay, we do think that the storms are brewing. And so when we look out into the back half of the year, we continue to think that the risk is skewed to the downside, Tom. I mean, in fact, just a few weeks ago, we further lowered our S&P 500 target for year end to 3,800.
So, Nadia, we've had people come on all morning saying there's an opportunity to buy the big banks. Do you disagree?
We disagree. We actually downgraded financials in December into strength to an underweight. And what you see playing out right now in the market was something that we were concerned about. We were concerned about deposit beta and increase of deposit costs. We think that we're still in the early innings of this competitions for deposit. We're just now seeing the accelerations in deposit beta and outflows. And reality is no one is immune. So we think that this will continue to have implications for profits and margins that are going to get squeezed in this environment. So, today's issue might be deposit betas and outflows, but tomorrow's issue might be net charge-offs. Yes, credit quality remains benign right now, but the normalization process is happening, and we could see an acceleration in that if we see a deterioration in the macro backdrop and if we see a pickup in the unemployment rate. We're all watching for payrolls coming up.
Just to build on that, Mike Mayo of Wells Fargo was on just a moment ago, and he was talking about how some of the concern and the stress will only consolidate market share and power among the bigger names. That yes, there could be a decline in profitability, but they can overcome that and compensate for that with more business. Does that resonate with you? I mean, are you starting to look at some of the strongest bank names for when perhaps there's a bit more pain and then you can take an opportunity to buy them?
Yes, I mean, you saw that in the financial crisis, and we're not saying that this is a financial crisis that's happening this week in the banks. And so we do think that the larger banks are likely to get larger and pick up some market share here. So you want to be in those quality banks if you're going to own banks. I mean, yes, get your shopping list ready. But again, we don't think that the downside is over yet. But maybe in the back half of the year and into 2024, you want to look at those more quality banks that has more sticky deposit base and also a more diversified business.
And Nadia, none of us have a crystal ball. We don't know what that jobs report's going to be. I think the administration knows. They get told about 24 hours before, the night before. So they know. We don't know. Nadia, what I want to understand from you, though, is how you'd respond to the incoming information. Can you tell me how low you think the bar is for a 50 basis point move? What kind of number gets it done? What kind of number doesn't get it done?
We think if we see something that is above 300,000, that it does increase the possibility of a 50 basis points increase. Of course, Chairman Powell gave us a roadmap this week of what would tip the scale for 50 basis points. We already got a pretty hot jobs opening number from JOLTS. We're also going to be watching very closely CPI next week, of course. But we think if you get something above 300,000 and you get the average hourly earnings that are about maybe a half a percentage points, that 50 basis points is more likely. But as you've been noted all morning, I cannot believe that what's happening in the banking sector will not give the Fed pause in this market. Right now, we're looking for a terminal rate, though, of 5.5%.
There we go. Nadia, thank you. Wonderful as always. Nadia Lovell there of UBS Global Wealth Management. Just your guide. Ellen Zetter and Morgan Stanley said 250 might get it done. Of course, all of that depends on what we get from CPI next week. That was a number of about 300,000. Cities down to about 255. They think 255 gets it done. So, Tom, somewhere in between 250,000 and 300K seems to be this ballpark figure that a lot of people think will leave that door open to a 50 basis point move.
I can give you fancy math about the standard error of the non-farm payrolls report. It's out the window. The statistics, the central limit theorem, gone after what we witnessed last month.
What I'm struck by is that everyone's saying something different. Every person who comes on with some measured conviction says, no, the Fed really should go 25. Like, they're not going to go 50. They're going to have some real issues because of the banking crisis. And other people are saying, absolutely
not. This is important because we've got a huge audience, and thank you so much for watching us. You're not global Wall Street, but you're just curious about this. And their heads are spinning right now over all these events. John Thomas just is out on Twitter with a really kind tweet to us, and it's British. He talks about our cheeky humor.
Oh, he likes that.
What is cheeky humor?
A little bit naughty.
Really?
Just a little bit. Not too naughty, just a little bit, the right amount.
It's cheeky humor. Maybe that's why they watch us.
Bear in mind that it's 1 p.m. in London and they drink through this show. Which is a
on
different
Fridays
experience.
Particularly.
They're already in the pub.
I did not know this. This is news I need to know. They're drinking in London.
That's why they already enjoy it. They're in the pub now, waiting for payrolls.
Do they have TVs in the pubs there?
Yeah, of course. They tune into us
in the soccer,
waiting
and then
for payrolls.
For our cheeky
It's a big event in the city. We're in pubs right now across the city of London, the Square Mile.
With Lisa's cheeky humor.
Good afternoon to you all, guys. The payrolls report about 20 minutes away. Ratney Krosner, formerly of the Federal Reserve, now of the University of Chicago Booth School, is coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Yes, just less than 20 minutes from now, the February jobs report will be released, and it's likely to help determine what Fed policymakers will do when they meet later this month. It's estimated that the economy added 225,000 jobs last month. A round of hefty payroll numbers could cement the Fed's resolve to hold interest rates higher for longer. Shares of Silicon Valley Bank have resumed their plunge, losing almost half their value in pre-market trading. That's following yesterday's 60% decline. SVB is a major lender to startups. Peter Thiel's Founders Fund and other venture capitalists have advised portfolio businesses to withdraw their money. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders are expected to agree to let the European firms benefit from some of the battery subsidies offered only to U.S. producers. And Bitcoin is having its worst week since November. An equity sell-off, fear over higher interest rates, and a U.S. crackdown on crypto combined to hurt investor sentiment. Bitcoin fell below $20,000 today for the first time since January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
To go back and justify that we stepped down 75, 50, 25, back up to 50, it kind of puts you in a place that you need to go 50 again in May. They're clearly concerned on the inflation side and that they're not making enough progress on the labor side, but I'm not sure that the noise that we've seen in the data in January justifies reacting to the February data. It's so noisy. We almost have to get to the March data to see what the real trend is.
Well, a little bit more data is coming out in about 14 minutes' time. That was the brilliant Christina Campmany of Invesco weighing in on this jobs report. We're looking for something close to 225. That's the median estimate in our survey. We'll break that down for you in just a moment. But this is what we're looking at right here, right now. SVB, Silicon Valley Bank, is down hard again. It was down hard yesterday by 60%. Right now it's down 67% in the pre-market. We talked a lot about that distinction that's being drawn between some of these small lenders and the large cap big banks, big integrated players like, say, Bank of America. B of A is only down 0.5% today, so clear lines being drawn here. But then, Tom, what pops up First Republic, a bank that you know well, was down hard yesterday by I think about 16%.
Yeah.
It's down another 12% right now.
Need to be careful here about the names because state to state, there's so many banks that overlap. This is First Republic Bank /CA, California. This is not the East Coast set of First Republic. I mean, how many First? We probably got 50 First Republic banks that I think of. But yes, this is tarred and feathered by the California experience. And again, it sums up to a set of banks, some directly in trouble and others maybe less challenged.
Food for thought for this Federal Reserve, Tom,
It is.
on top of the payrolls report that we get in about 12 minutes' time.
In this historic moment, we are thrilled to bring you someone unusual for Jobs Day, Randall Krosner of the Booth School of Chicago, former governor of the Federal Reserve System, and truly one of our experts on the financial dynamics of our system. Randy, this has to be a different interview today. I really don't care what you think about non-farm payrolls. What I do want you to help our audience with worldwide is that the Fed, out of the Federal Reserve Act of 1913, there is a true dual mandate. The monetary and financial system. Explain how Chairman Powell goes between the monetary challenges of the moment and what we've observed in the last few days, the financial challenges of the moment.
Good, and I'm really glad you drew the distinction because I think sometimes people muddle the two pieces. And like if you think back to what happened in February, March of 2020 when COVID first hit, the Fed started buying a lot of assets, and particularly Treasury securities, because there was dysfunction in that market. They then decided to do quantitative easing, but the initial response was really separate from the, and that was a financial response, separate from the longer-term monetary policy response. And so, of course, the Fed is going to try to avoid financial tumult and try to make sure that markets work appropriately. But it's also got to be worried about bringing inflation down.
What do they do this morning to provide comfort to the troubled and less troubled banking system? What is the action the Fed will take, say, over the weekend and into next week?
So obviously the Fed monitors all of this stuff very closely, and they have very good data on the deposit outflows and the amount of capital. And so I'm sure the Fed is totally on top of this and sort of knew what was going on even before it was reported in the in those earnings reports and in some of the public reports. So they're making sure that that banks have access to lending. The central bank can do direct lending to banks and financial services firms. If there's dysfunction in any market, they can purchase assets in those markets, and they can just do that like that, as they did. Well, as we did back when I was at the Fed during the global financial crisis, and as they did very expeditiously when COVID hit. So I'm sure they've got all the pieces in place. They know who is vulnerable, and they'll be there to provide support if there is a problem. Hopefully there won't be, and I think this will be likely, I mean, at least right now, it seems to be fairly isolated, but they'll be ready.
Do you think, Randy, that Fed Chair Jay Powell is doing a good job of communication?
Yes, I think he's been incredibly consistent. I mean, you've heard me on your program for like 8 months now of saying he's had a really consistent message since July. The markets, I think, have not been willing to listen. You know, and as I've described, I think part of that is because there's so many younger participants in the markets. That is, people who haven't been there for 20 or 30 years, like I have, and to know that the Fed at some point will take the punch bowl away when the party really gets going. And they're going to keep at it. And it seems like the market's always surprised when Jay Powell reiterates, well, we're going to keep at this until we bring inflation down. And if inflation is not coming down, we're going to keep at it. He basically said the same message, but the markets got really jittery about that. I think it's been very consistent.
We have heard, though, a slight shift in tone, have we not, about in terms of the balance of risks and that they're becoming more balanced, less sort of weighted to fighting inflation that seem to have changed of late as we get some revisions that point to a hotter market. I'm curious, from your vantage point, whether your sense of what it means to take away the punch bowl has changed with potentially a higher terminal rate in your imagination than you previously thought.
Well, we've talked before about that they would end in the mid fives, and I think roughly that's like where they are to be. I mean, Jay wisely has not set a particular number because it depends on the data. I mean, obviously, the jobs market was a lot hotter last month than anyone expected. That's why this number is so highly anticipated. We also have an inflation number that has been gradually coming down, but last month's personal consumption expenditure index ticked up just a little bit. So that Jay has always made it clear he's going to be responding to the data. He's going to be looking at what's going on. Nothing is preset. And if the job market is still at 53-year record low unemployment levels and inflation's not coming down, they're going to keep working at it. As I think I've said this before on your program, until the labor market quits, they're not going to quit.
Randy Krosner is going to stick with us ahead of the payrolls report in about 7 minutes' time. We're looking for about 225. I'm almost laughing.
I know.
I'm biting my tongue.
I know you are.
That is such the establishment view of how the Federal Reserve operates. I get it. And Mike McKee, you're on board, I know, so you can say whatever you like in 2 minutes' time. To say that he's been consistent is ridiculous. And to say that it's the market's fault because the market doesn't understand the Fed is equally as ridiculous. It is the Fed's problem if the market is not hearing the message they want it to hear. And you can't change at Brookings and talk about balanced risk. You can't talk about the disinflationary process starting. You can't talk about adjusting the pace and not expect volatility to come around in financial markets. It's a ridiculous conversation.
Look, this is, and Mike, you can weigh in on this. There is another aspect to this, which is how do you remain consistent in a highly inconsistent universe? And that is sort of the question, right? Do you create this sort of balance of risks and stick with it until you see real pain rather than wait to sort of change the rhetoric in the face of something that is hopefully the immaculate
Mike, the floor is yours. The floor is yours.
Well, I would go back to what you said earlier on the show. You should treat traders like they are golden retrievers and maybe talk to them.
I was asking to be treated like a golden retriever, just to be clear.
That may be what the Fed needs to do. But at least it's got a point. This has been a very volatile economic data couple of months. And so it is kind of hard to remain consistent. The view has remained consistent, but the language has maybe not, and that has maybe caused some problems. But, the Fed doesn't have to move until March 22nd. So this is really a problem for the markets because they're the ones who want to try to figure out what's going on a day-to-day, minute-to-minute basis.
Randy, I did invoke you by name almost, so you should have the right to respond. So you've got about 45 seconds if that's enough time.
Sure. No, I understand your point of view, and I think it's sort of along the lines of what Mike was saying. I think his approach has been very consistent. They're going to keep at it until inflation comes down. Exactly as Lisa had said, we've had a lot of variable reports. I mean, I think the expectation was that the unemployment rate would start to move up a little bit, the jobs market would weaken. It hasn't. Inflation rate has come down, broadly consistent with the Fed's forecast. It ticked up a little bit. But I think the general message has been quite consistent that if the data are not consistent with the inflation rate coming down, they're going to keep at it. And that's why I'm surprised that the markets are so surprised at that, because I think he's been consistent in that big picture message. The data have been quite variable.
Mike McKee and Randy, you're going to stick with us. Randy, you got the final word there. You'll get the first word coming out of the payrolls report as well in just a moment. TK, it's about 4 or 5 minutes away.
Deutsche Bank Publishing, they suggest it is the most restrictive it's been since the late 1970s.
Equity futures right now
a few years.
down 0.25% on the S&P 500. Yields lower at the front end by 8 basis points on a 2-year. What a trading range over the last couple of days. Your jobs report in America up next. Around about 20 seconds away from a much-anticipated jobs report. Will the month of February confirm the January boom? Going into this data, we're looking for a number in and around 225. That's the median estimate in our survey. Equity futures are negative about 0.2% on the S&P. Bond yields are lower, much lower. Going into this, we're down 7 basis points on a 2-year to 480. With the jobs data, let's get to Michael McKee. Hey, Mike.
Well, here we go, and it is stronger than expected. Here's Johnny, as it were. We're going to lean to 50, I guess, because it's 311. 311,000 jobs created in the month of February, according to the Bureau of Labor Statistics, and that is I'm looking to. I'm not seeing the revision immediately here, but the change in non-farm payrolls, the net revision is down 34. So we did get a revision to January, and I can pull that number up for you quickly here. December revised down by 21,000. This change for January revised down by 13,000 to only 504,000. So not a major change there, but we do have a much stronger than expected payrolls number. The unemployment rate, though, does bump up to 3.6%. That was unexpected. There was no change priced into the forecast. Average hourly earnings fall 0.2 they rise during the month, so they fall from a 0.3 rise the month before. On a year-over-year basis, that puts us at 4.6%. You got to calculate base effects in there, but that is smaller than anticipated. The labor force participation rate comes in at 62.5, so that's an increase from 62.4 the month before. And the one more thing we got here, the average weekly hours fall from 34.7 to 34.5. So you've got some signs of slowing in here, and you've got some signs of increase. I'll let you see what the signs in the bond market are being read at, and I'll get you some numbers
This
here.
is super difficult to read. So I think at the moment, and I stress for the moment, we're not trading on that headline number. We're trading on a softer wages print. We're trading on a higher unemployment, increase in participation, a reduction in hours worked as well. And we've got a big rally in the bond market again. So yesterday, the 2-year yield was down 20 basis points. It's down another 18. Think about where we've been this week. 5.08% 2 days ago on a 2-year, and right now, 4.69. That is a big change. So yields in aggressively in the bond market. Equities higher by about 1/3 on the S&P. And as I say, and I'll repeat it, the first move, not always the right move, but that's the early interpretation of this incoming information, Tom.
There's no question about that. As Mike digests the data, I'm just going to say that as I look at the green and the red blinking on the terminal, John, it's simple. This is a disinflationary pulse and sets us up for what if we see on Tuesday some form of disinflationary trend.
I reject any interpretation of this initial read whatsoever in terms of the
There we go.
longer-term
I like that.
expectation. I completely reject that.
Because they're going to come to me and say, what do you think?
Well, I mean, looking at this, it makes no sense. We had person after person come on this show and say they're going to be forced to go 50 basis points if you get above that 250 number. We got 311. We did not get a significant downward revision to the prior month's employment report. By all levels, this is a very strong labor market that still gets revised to the upside. So yes, the Fed can say whatever they want, but the bottom line is, based on what Fed Chair Jay Powell's laid out for himself, it's going to be really hard to parse this.
Let me give you a quick possibility here. When you look at the jobs that were created, construction jobs were on the month up by 24,000, a bit of a surprise, but manufacturing jobs down 4,000. That's the first loss in a while, and it's also a suggestion that people who had higher paying jobs were struck from payrolls. Leisure and hospitality is the biggest job gainer, 105,000, and that suggests that we're still trying to fill jobs that were open, but they are lower paying jobs. And so maybe we're not seeing as much wage pressure as we had seen. And my initial reaction when I saw the number was, here we get the no landing guys coming back again. You know, what if we have?
So that's your interpretation. Seriously,
no, I'm not going to. I'm going to be with Lisa on this. It's a little hard to interpret it. I don't want to give you a quick answer, but I suspect people will say, well, maybe we don't have to have a hard landing, and we can bring inflation.
I value revised data as we get to our esteemed guest, John, and it's real simple. There's over 1 million jobs in the last 90 days. The 3-month moving average with revisions is 351,000. There was a point where Randall Krosner ripped the chalk out of my hand and said, Tom, the demographics say we could go under 100,000 as normal. We are miles away from a normal job economy.
It's really difficult to stay open-minded after the jobs report, especially in the first few minutes. But given experience, sometimes the first move is not the right move. But I will keep stressing that's the early interpretation of the incoming information so far. Seemed to de-emphasize the headline number, which is a clear beat and in line with what people said would lead to the 50 basis point door remaining open, but the attention is firmly elsewhere at the moment. A lift in unemployment, an increase in participation, a reduction in hours work, and a disappointed in wage growth. Disappointment, downside surprise there month on month. So equities are higher, and I'll keep saying for now until I go home at about 10 a.m. this morning. I'll keep saying for now because I have no idea what this is going to be like at the close. And in the bond market, yields are aggressively lower at the front end by about 17 or 18 basis points on a 2-year to 469. So what's that, about 40 basis points south of where we were 2 days ago on a 2-year yield. Tom, I stressed, it's this together with next week, the 14th, the CPI print still to come.
Well, we're going to continue. Mike, do you have any jewels you want to share with us quickly before we go to Randall Cross?
Well, I just would point out that in the unemployment rise, we did see a big rise in unemployment in the household survey, 5,936,000. That's an increase of 242,000. The level change for employment was an increase of 177,000. So more people got jobs, but more people report losing jobs.
Right.
Almost no change in the labor force, so that's not really, well, it's 419,000, but that's down from 866 the month before.
John, did Silicon Valley Bank trade off the jobs report?
SVB still down and down hard, Tom, by 62%.
The
They're not getting
headline
any
says,
relief at all.
trading halted with news pending. Mike McKeel continued to digest this, and through the 9 o'clock hour, who do you have on 9 o'clock? Rick Reeder's going to be there?
Do you want the tease? I'll do the promo now if you want.
No, seriously.
Next hour, Rick Reeder of BlackRock.
On 6%.
Mohammed Al-Arian is coming up as well. We'll catch up with Tiffany Wilding of
Non-transitory.
PIMCO.
He's buried in snowdrifts in
PGIM's
Cambridge.
Mike Collins. And you know who's getting a big wage increase? We'll catch up with the Labour Secretary as well a little bit later.
This is his final interview?
It's going to be the final
Be
interview.
nice.
He's doing
Be
okay.
nice.
We're
we can talk
having a
about
hard
quits,
time.
wage growth, and all of the above, Mike.
They get a penalty 2 minutes cross-checking or something
We're having a hard time deciding what the Fed is going to do. The 50 basis point move is bouncing around the 50% mark right now, 53%.
Can I say this before I run? If you get a hot CPI print next week on March 14th, everything else in this report gets de-emphasized.
Yes.
So the stuff that we're trading on now, which is softer wage growth, will get completely
If you
ignored.
get a disinflationary vector?
If you get a hotter CPI print next week, because people will
Agreed.
just put the hotter CPI
Agreed.
print together with the big headline.
What does a modest disinflationary vector mean off Tuesday? To me, it's massive
That would be
news.
super encouraging, Tom, together with the wage growth participation figures. That would be that would lead that would give the Fed an excuse to back away from the 50 talk for sure.
Well, futures up 9 right now. The VIX 22.91. We continue as we do with the former governor of the Federal Reserve System, Randall Krosner. Before we spoke about the financial side. Now, Krosner on our monetary system. Randy, in this milieu, can you use theory? Can you use anything that was invented at Yale years ago or at London School of Economics? The theories that matter, are they valid and beneficial at this time?
Even some of them from University of Chicago too. I think it gives us a broad framework for thinking through these issues. But exactly as you were discussing, these data are not clear. And as we were talking about with Lisa before, the data have been quite volatile and sometimes difficult to interpret before. And gosh, this report is not completely consistent. Although I think Mike may have hit on exactly one of the issues in the so-called composition effect. If you're growing a lot of jobs in the lower wage part, like hospitality, but losing them in the higher wage part, like manufacturing, that could lead to that number coming down, that average hourly wage, but wages may still be going up because in each of those individual categories, wages may be up. So we've got to get more data on that. So, yes.
To speak to the Chicago theory, Lisa's been beating me to death with long and variable lags. Does that math work now? Is it useful?
Milton Friedman articulated that like 70 years ago, and I think we're still seeing that. We certainly have seen some lags. We've certainly seen some hit in housing market and in certain sectors, but not in all the sectors. And obviously there are lags, and we'll see when the tightening of monetary policy really hits. May not come for a few more months.
Randy, we're seeing in markets people back away from the likelihood of a 50 basis point rate hike at the meeting of the Federal Reserve later this month. Do you think that that's valid, given the guidance, given the strength of the labor market, given the lack of significant downside revisions to what we saw in January?
So we still have a very strong labor market. There's no way around that. And especially at this point after the Fed has been hiking for a full year, those lags might be long and variable, but this is a bit surprising. See so little impact, and so I think I don't think the Fed has made their decision. I think exactly as John said, as well as Tom, the inflation report is going to be very important because it's really, this is one input, a key input into what inflation is going to be. And that's ultimately what the Fed cares about, is bringing inflation down. If we do see inflation starting to come down, some around the table may feel more comfortable to just say, well, let's stick with 25. But if they don't see signs of it coming down, and you just look at this labor market being pretty hot, I think a number of people will want to push for 50.
It's early days yet in terms of the market reaction, but the knee-jerk reaction seems to emphasize the decline in average hourly earnings and the tick up in the unemployment rate as why perhaps the Fed wouldn't have to go quite as far as previously believed. Do you think that these are significant things, that these are developments that highlight softening around the edges that will show up later on?
Well, as I was saying, that the reduction in the average hourly earnings may just be a composition effect, and so I think it's hard to interpret any one report in too much detail, and really say, well, the Fed's going to change because of it. I think looking over the last 3 months, we still see a very strong labor market. I think that's what the context in which Jay Powell gave his testimony. I think the labor market is still pretty strong. It doesn't seem to be strengthening, but if it were, then I think it would be very clear it'd have to be 50. Now, I think it's reasonable that the market say it's an even bet, but I think a lot will be determined by the inflation number on Tuesday.
Professor Krosner, thank you so much for joining us today from Madrid. Obviously, Randy Krosner with the Fed, and also with the University of Chicago Booth School as well. We now turn to bond market reaction. He's aged overnight. Jeffrey Rosenberg joins us now, portfolio manager of Systematic Multi-Strategy Fund at BlackRock. Jeff, open question. What's the multi-strategy right now?
The multi-strategy is defensive here, Tom. I mean, there's a lot of focus on 25 versus 50, but I think the real message of the week was that Powell reemphasized financial conditions need to stay tight for transmission of monetary policy to work. And the thing that we lost sight of here is how is monetary policy supposed to actually bring down inflation? It functions mainly through financial conditions tightening. And when you look at where we were at the end of January, financial conditions were basically back to where they were before the tightening even began, effectively unwinding all of the tightening in policy. So the pushback here is coming from the data. And, we can parse today's payroll report. I would emphasize the earlier conversation. AHE is the worst measure of real-time or near-term measures of wage growth because of the compositional effects. But beyond the noise of the data, the issue is that financial conditions aren't tightening enough. And Powell pushed back this week, and that means that it raises the prospects that they have to do more. That's the 50-25 debate, but it's really the terminal debate that is important here, and that they're much more willing to push the risk up of a recession.
Jeff Rosenberg, you're going to take in the various narratives and you're going to filter them through a Carnegie Mellon education, which is hugely probabilistically determined. Fine. Can you state that we are in a disinflationary trend now? What is the probability that the vector coming off of this report and coming off Tuesday will signal disinflation?
Well, I think what we had is finally the realization of peak inflation. And remember, that was the big debate for a while was, the expectation that we'd hit peak inflation would come down, and it just kept getting disappointed. Last November, we hit the peak inflation, and everybody got very excited by 3 months in a row of very good inflation numbers that showed a decline. But decline to what level, right? The Fed is talking about getting back to the pre-COVID 2%, and nothing in the data that we're seeing in terms of the persistent measures of inflation, which is really that core services, ex-housing services, which is really about labor and markets and wage inflation. Nothing has really said that the Fed's tightening to date has done the work that's necessary to bring that back to 2% target to have that be accomplished.
Jeff, you were talking about the financial market conditions and how that's really important for the transmission of Fed policy. I'm looking now at the terminal rate being priced in, a 5.3%, down from 5.6% earlier this week. Do you think that this is an accurate response to the report that we just got?
Well, I think the market is being whipsawed a lot around positioning and technicals around 25 versus 50. So you have to be careful about over-interpreting kind of the longer run fundamental interpretation from today's news. And as John was saying earlier, come Tuesday with a hot CPI report, all of this is going to get sort of thrown out and reinterpreted. I think the broader message of the raising of the terminal rate is the right response to what Powell said earlier this week, that we need to do more. And that's really the broader message of the failure of the core measures, the labor market measures, the core housing services measures of inflation to really respond to what is a very significant amount of tightening to date. So it's higher for longer, and you got to price out that expectation that the Fed's going to turn around very quickly and be able to cut interest rates as well.
My head's spinning, Jeff. I got to be honest. Everyone said something slightly different. Everybody has a different base expectation of what the Fed's parameters are to hike rates.
It's like the Bravo dining room table.
I mean, yes, actually, that's completely accurate. I'm looking at this. Is there any certainty in your investment thesis that you have continued to drive home that you continue to have conviction in, Jeff?
Well, you're going to hate this answer. The only certainty is the uncertainty.
Oh, dear Lord.
He learned that from Alan Meltzer. That's Alan Meltzer 101.
Come on.
Continue.
I knew you weren't going to like that one, but it's about recognizing that there is a lack of ability of forecasting inflation. That's really the issue here, is that the market consensus is pretty confident, or was pretty confident, in a steady return to 2%. And the history of the accuracy of forecasting inflation here just doesn't bear out that degree of confidence. And so it's really about recognizing what we know and what we don't know relative to what's priced into the market. And there you certainly saw a lot of skew to the downside, and that downside has been playing out, over the course of February, the first part of March here.
Jeff Rosenberg, always thank you. He is with BlackRock. The VIX in nicely, almost a stick, 21.7 off, 7.9 off the angst yesterday. NASDAQ up 0.8%. Michael McKee quickly here with an observation of 47 pages of BLS data.
Well, a couple of quick things. One here is that the number of retail jobs increased by 50,000, most of those at department stores. So that gives you some indication that perhaps retail sales have not pulled back or did not pull back a lot in February. Also, retail employees got the biggest raises, up 1.1%. We talked about leisure and hospitality. They were just up 0.3%. And manufacturing was flat. So the story kind of holds that we hired people in lower wage occupations and not in higher wage occupations. The other observation I would make is we have now dropped to a 34% chance of a 50 basis point move in the market. So people rapidly pricing that out.
Let us continue now. We will with Ira Jersey. He has been known for years on Wall Street for short-term rate analysis. That is really important here as we see LIBOR 3-month and the SOFR and the rest of it go out near 5%. He is our chief U.S. rate strategist for Bloomberg Intelligence. Ira, I keep asking this, but do you see a disinflationary trend in place, even if it's ever so shallow?
Well, there is. We had that one little blip in a lot of the data in January, which gives us a lot of pause. But we have to keep in mind it is only one data point, and we have to look at all of the other data in totality. So, today's data I don't think really moves the needle that much for the Fed. Maybe they go 25, but we still don't know where that terminal rate's necessarily going to be. Because if the data doesn't slow down and we still see some inflationary pressures, then the Fed is going to hike more than we originally thought.
You're not on a trading desk. You used to be. Is there opportunity, Ira Jersey, in these gyrations in spread and also just simply nominal levels?
Well, there is, and trading desks generally like volatility as long as it's kind of predictable volatility. And I think some of the We came in this morning and we already saw that the Treasury market had rallied quite a lot, with 2-year yields better by 15 basis points. And that's an environment where if you're a trader and you had a position overnight, you're either loving it or hating it. And today's numbers this morning, we saw some volatility around the knee-jerk reaction. But yeah, I'm sure that there is some trading opportunity, and people can take advantage of that in the very short term. Investors, on the other hand, people who have a longer time horizon, 3 months to a year, for example, which is kind of the sweet spot for where I try to look, is that's a little bit, it's less obvious what this means, or what this one data point is going to mean for that longer term trends in yield.
Let's stick on the immediate reaction for a minute. One Twitter user who calls themselves Exhausted Bear writes, "If I knew the print ahead of time, I still would have lost money," because that is how sort of strange the trading activity was to some who just were looking at the headline number and what everybody was saying ahead of it, what the bar would be to raise 50 basis points at the next meeting. I'm just curious, from your vantage point, all things being equal, does this, in a report that we just got, raise the terminal rate that you expect the Fed to get to?
It doesn't. It actually probably lowers it or decreases the chance of a 6% terminal rate at this point. And not so much because of that headline 300,000-ish payrolls number, which is a solid number for sure. But when you look at the totality of the data, and we have to remember, the knee-jerk reaction is often that red headline on the Bloomberg terminal where payrolls are. And then when you look at the wage data, you look at the hours work data, you then look at the household survey and realize there were 242,000 more unemployed people this year, or in February, than there were the month before, right? So when you look at the totality of the data, it is much more mixed. And that's one of the reasons why I think you got this big knee-jerk reaction, and then things settled back down to where we were prior to the number coming out.
Ira Jersey, thank you so much. To have Jeff Rosenberg and Ira Jersey back-to-back speaks lots to our booking team and talking on bonds. Here's how crazy it is, and I usually don't admit this, but with McKee next to me and all we've been through over the years, it's so crazy right now, folks, that often, Mike, I look at the top of a research note to see when it was written and when it was released. That's how quickly the gyrations are occurring. And I do this with Edward Harrison of MLive, wonderful and acute work on the markets and linking into economics. Ed Harrison of Bloomberg joins us right now. Ed, I cheated. I looked at your brilliant note pushing back from no 50 beep rise, and you wrote it a good number of hours ago. This jobs report confirmed your idea that we won't be so abrupt.
Yeah, I think that the 311 number, I have to agree with Ira, it doesn't tell the full story. The real story is that we know that there were a lot of jobs that were being lost. We know that from Bloomberg Economics that it takes 60 to 90 days before those people to start filing for claims. So we're kind of seeing that from the household survey with a 3.6% unemployment. We're seeing at the same time more people entering the labor force, which should help keep wage pressure down. All of that suggests that the Fed had wanted to go maybe to 550, 575 at the most. And I think that this is in line with that.
You were weaned at Dartmouth within the Blanchflower bubble. And David Blanchflower has been world acclaimed for questioning labor statistics. He thinks it's a much more fragile labor economy than some of the enthusiasms. Is that what your work shows at Bloomberg?
I think that the economy is relatively hot. So I'm probably not on Danny's page there, and I also know that he has been very negative on the rate increases. But purely from a financial stability perspective, you could say that the rate increases make sense. I think one of the key factors is this SVB thing. It's telling the Fed that long and variable lags exist. Because what's happening with SVB is something that is related to what the Fed did, say, 3 months ago, 6 months ago, from their portfolio, the contagion from that. And so that's going to give them pause, not only about 25 versus 50, but also what their terminal rate's going to be. So I think that the totality here is speaking to a labor market that's still very good, but also a Fed that thinks that it could be decelerating very quickly.
And we should mention, Lisa, Silicon Valley Bank halted for news. It's called the Bramo halt.
We'll keep that in check, and we'll keep you updated on that. But Ed, I am wondering about the room for nuance at a time of otherwise hot labor market prints. We're parsing through the details of a report, and perhaps rightly so because of those long and variable lags. At the same time that revisions have been to the upside, not necessarily January's, but otherwise for a number of months. Do you think that there is enough room for nuance, Ed, at a time when otherwise, as you point out, this market has remained, perhaps, or this economy has remained more resilient than the Fed expected?
Yeah, I think that the reason that we have nuance particularly is that the Fed stepped down to 25 basis points. And you have to ask yourself, why did they do that? The reason they did that is because they thought they were nearing the end. The data that we got in January, which was, some people think, an aberration, caused them to rethink that. The markets rethought the data more than the Fed rethought it. And so I think that the markets are now moving back to where the Fed likely is, and we'll just have to see what the CPI data say. But my view is that the Fed wants to make it, a few 25 basis point hikes at the most, and then they want to hold, and that's it. That's the path that they want to be on.
Just as we get some of this banking news, and as we see some moves, not just in SVB, but also in First Capital, as well as Zions Bank, I'm wondering from your vantage point, what you're seeing with respect to not necessarily credit markets that are public, but private credit markets. Is there concern there? Is there the feeling that there's going to be forced sales that put more pressure on valuations?
I think that this is a problem that SVB is bringing up because they have a big book of MBS, CMBS, and what we know is that the occupancy rates for CMBS in particular are lower, and we've already seen some handing in the keys from tenants. That is that they decided not to pay their mortgage. This is the sort of thing that is going to be a problem, not just for banks, but for the wider financial community. Because in private markets, this was a place where people were trying to pick up yield, and I think that it could be a problem over the next 2 or 3 years.
Edward Harrison, thank you so much, with Bloomberg here on the historic moment, linking markets into our economics. Lisa, I really don't know where to begin. I'm going to go to Mike Mayo earlier today on banking, and something he said in a quick of a sentence, which we really didn't discuss. He's doing what I'm doing, watching commercial real estate out front. You've got a massive focus on this within fixed income. But I'm trying to find, it's like the butterflies in Silicon Valley, and what do they mean flapping for banking on the East Coast? That's sort of the arch debate. And I'm just wondering, given the swirl of everything we're in right now, what's the tea leaf I should be watching? And I'm guessing it's commercial real estate.
A lot of people have been watching commercial real estate.
I'm
if you
not
take
sure
a look at valuations, I mean, I think, though, that this is a big concern considering not just property values pinned to mortgage rates, but also just the shift to working from home, from office space, and what that read-through could look like. That said, I think that you raise a great point. What kinds of financial read-throughs have we not seen yet that might give the Fed the opportunity to take advantage of the market response to this report, whether right, whether wrong, the market's response as an excuse to go just 25 basis points? Are they getting a green light to do that without causing any kind of disruption?
The other thing, Edward Harrison was very good on this about GDP coming down. We didn't even mention it today. We may get a Brent crude of 79. I've got Brent now at 82.04, and it made a dash for 81.80 earlier this morning in the angst. That shows you that global slowdown, even with what seems to be a better China. And I'm wondering here, the GDP calls we may see off the inflation report.
I'm so confused. I'll be honest. I'm trying to put this together in some sort of cohesive narrative. I can't. I'm not going to try. I think that what we're seeing right now is, as Randy Krosner said, a hot labor market. We are seeing signs of softening. It is backward looking, and we're seeing real moving, really serious signs that there are just pockets of distress that are forming.
It's okay to be confused here. I really can't convey that enough, folks. The ambiguities of the moment, extraordinary. Stay with us today on Bloomberg Television and Bloomberg Radio. Good morning.